Okay, you guys can see my screen? I just want to make sure. All right, cool. Okay, guys, so let's get started. Welcome, everyone. This is our discussion number 298, almost 5.5 years. We meet every Saturday morning, unless I'm traveling or have some other work, any other emergency for which I have to be away. Otherwise, if it is on a meetup, it is happening. If it is not, if I'm not able to host this, I will cancel it on the meetup, right? So today's session main agenda would be to go through various earnings of a big tech companies. I plan to cover Amazon, Google, Microsoft, Apple, Meta, and my single biggest position, Mercado Libre. But as always, we'll start with at a macro level. What's happened at a macro level? What did I see? What's happening on some other news around the companies, and then we'll break out into different breakout rooms where we can talk about. I know one of the most famous rooms will be crowded rooms will be in an options, right? You want to talk about options? Go there. I also created a new room last week. Someone had requested around TA. You want to talk about technical analysis or charts? Go and talk to other people. So with that, let's get going. As always, anything that we discuss here is just for education, and don't take it as a financial or tax or any kind of other advice. I spend most of my life in the technology companies, so so you you can do worse than taking financial advice for me. So let's look at it. Yeah, before we start, I always want to start some investing thought. So thought for today is investing should be more like watching paint dry or watching grass grow. If you want excitement, take your money and go to Vegas. I think we talked about multiple times here. The same concept wherein, hey, I want to look at company because that's too volatile, super exciting to be in this company. But if you want excitement, go to Vegas. If you want to gamble your money, there are many other ways to gamble the money. Don't do it in the market. Find great businesses. At least that's what I want to focus on, in find great businesses and just hold on to it. Right? Figure out how you stay as a owner of that business forever, until business gives you a reason to ditch it. If the business is doing fine, I would like to own it forever, right? That's what my focus is on. So I'm not going to talk about you know mm, around stuff like, okay, I'm buying it now, and one of the questions that I generally get asked when I start a new position, okay, what's your price target for next year? I don't know. And I don't care, right? What's my price target for next year? Because I'm going to own it for next 5, 10, 15, 20 years. Hopefully just pass it on to my heirs, and own it forever if the business continues to perform. So I generally don't have a price targets, etc., like exit price targets. If a company become egregiously expensive, which I will talk about one company today, we have talked about it multiple times already, but the stock price continues to go higher, right? Whether the business is not catching up with the stock price, then yeah, I will trim some of the position because now it is egregiously expensive. But otherwise, yeah, if the stock price is not going or not, there are stocks which have gone up 200% this year. Hey, my stock is only gone up 20%. It's okay as long as the business continues to do fine. All right. Uh, let's look at a macro side of the house. So we had a FOMC update this week. This week was a pretty busy week because not only we had a big tech earnings, but we also had a Fed meeting. Um, I see a comment from Ramesh. Yeah, let me guess, Palantir. Exactly. So we will talk about it. Yeah, so we had a Fed meeting. I think uh, last week we looked at Fed Watch tool, CME Fed Watch tool. 98% market was expecting that we're gonna get 25 basis points cut, which we got. Right, so we got a 25 basis point cut, but not just the cut, but we also Fed, I mean, Chairman said, Powell said that they will stop reducing the holdings of US government bonds, right? So along with the rate cuts, Fed was also looking at earlier, they were also reducing their balance sheet by by not renewing the bonds. But now they would, basically also reduce their holdings. So from that perspective, both things are good. Little bit of a I think for this, but it's great. But the bigger surprise, I would say surprise, or things that market was not expecting, was a statement from Fed chairman saying the December rate cut is not done deal. I mean, he would never confirm. We have seen, but the tone, etc., coming from chairman were like little bit spooked the market a little bit, saying, oh, maybe we were pricing almost 90% probability of a rate cut. Now if you look at a CME Fed watch tool, I don't know where it is now, probably less, I guess it will be less than 90%. So let me bring that up. So last time we had a 90% probability. Now we are looking at December rate cut is only 63%, 60%. So from being surety, saying, yeah, I think Fed will get another 25 basis point cut in December. Now that's like almost 50-50 chance, right? So we also saw that the 10-year US government bond sold off, which pushed the yield higher, because now it is possible that the rate may stay a little higher than what for a little longer than what we have been, or market has been anticipating. So the bond sold off. If you own a long duration bonds, probably that will get impacted more. But it is what it is. Another thing to note, which we haven't seen earlier, I mean, most of the time, these Fed decisions are made by consensus. All the FOMC participants will kind of, have a unanimous decision. But over the last few meetings, we are seeing that there have been some dissents. Probably this is the first time where we had a two dissents, and both are on the opposite spectrum. One dissent was we should do 50 basis point cut, and another one was, oh, we shouldn't do any cuts, right? So it was completely on the opposite side. It is what it is. We got 25 basis point cut. Be happy with that. We'll see what comes in December, right? Maybe we'll get another 25 basis point cut. Maybe we won't. We'll have to wait for where the inflation number goes, what happens to the rest of the economy. If the labor market continues to worsen, maybe we will get a 25 basis point cut, or maybe 50, who knows. And I don't want to predict anything. Macro predictions are kind of exercise in futility. Really doesn't matter from our investing process perspective. But so we'll take it as it comes. Any other thoughts on what did you see around the Fed meeting? We got one more meeting, which will be in December. So we'll see how things happen in December. Any other thoughts? Anyone want to share? All right. So other thing that happened this week was a tariff discussion or a meeting between US and China. So a few things that came out from is that US will extend the pause on reciprocal tariffs for additional year. We will have the 20% fentanyl related tariff that we had slapped on China earlier. Third thing is that the China would now, earlier China had put a restrictions on the exports of rare earth minerals. So they will loosen that a bit. They will pause those restrictions. Plus they had promised to restart the soybean purchases. We will see what happens. I guess from the administration perspective, it was touted as a huge win, but we'll see. All these are promises. We have to see them convert into into reality, right? But if we do get a truce between US and China, if all the things that we talked about is implemented, then that will be great for market. China itself haven't had a great last 4 years, right? China has been struggling. Their economy has been struggling for almost last 3.5 years, if not four. Ever since the property bubble had burst in China, they've been having tough time. And now with the tariff and all that, their export economy not impacted so much because they found different markets, but didn't grow much as well. So we'll see. But having any, getting through this whole mess of all the tariff stuff will be great, will give uh, some certainty to businesses. Businesses want They don't like uncertainty. You tell me this is what's going to be, I will manage my business accordingly. The biggest issue for the businesses is you say one, then you flip, and you change the rules of the game again and again. That doesn't work out. Vinay is saying, if this is a structural change regarding jobs due to AI, doubt if decreasing interest rate helps, except perhaps making investment in data center, which could lead to a bubble. If you heard, the CEOs of the companies will never say it is because of AI, but we know what the reality is. If you heard Amazon during the Amazon earning call, the question was specifically asked to Andy Jassy around all the layoffs that Amazon has announced. They did what, another 15,000 layoffs on the corporate side, and then I think based on their investments in AI and automation, they're not gonna hire close to 160,000 workforce that otherwise they would have hired. In any case, I mean, they will never say it is because of AI. It was like, hey, this is how we operate. We got bloated during the COVID. Now we're like cutting the flag. But Fed cannot increase. I mean, Fed interest rates will not directly um, increase the labor participation. I think Jerome Powell said that the labor market, numbers had weakened because we do not have enough of labor available, because of also the slowdown in immigration, and the participation rates have also come down. He didn't specifically address the layoffs that are happening in certain industries due to use of better technology. So, and third thing at a macro side is around the earning stuff. So corporate profitability, I mean, companies are still making money, man. Despite all the things that we've been hearing, um, oh, all the shocks that have happened to the economy over past many years, like starting with COVID, tariffs, the geopolitical tensions, companies are still able to make money. Right? So we have almost 2/3 of S&P 500 companies have reported, and majority of these have delivered stronger than expected earnings. So here's a quick chart around in terms of how many companies actually beat, miss, or met their EPS. Almost, I would say, on an average, like 70%, more than 70% of the companies across all the sectors, not just one, all the sectors, they actually beat their EPS. The street estimates. Now we could argue that the street was a little pessimistic going into Q3, but it is what it is. Companies have still been able to beat the Wall Street estimates. Funny thing to see on the communication side, probably that's the lowest one. But look at the staples. Staples is one of if you look at overall sector specific, staple stocks haven't done well. I think this is probably the only sector which is in red. I do have a table, I guess. Oh yeah, right. If you look at the staples, is the only sector which is in red. Every other sector is in green. So probably analysts had a very low expectations around the staples companies, and that's why almost 100% of them beat their expectations, right? So, but this is a good thing, right? I think last week we talked about it. Bull market doesn't die of old age, right? So we are now in 3 years. We've completed 3 years of bull market. If you're wondering how far can it run, we don't know. We have seen bull markets much longer. Bull markets, we go back to last week. We looked at different charts of the duration of the and the length of the bull markets and how much the market grew during the each bull market cycle. 3 years is not that big a deal, right? And we are almost maybe just double or 95, 96% higher than where we were in October 2022, right? It could continue to go higher, provided we continue to see companies performing. We continue to right now, I think AI saved the market, and if we continue to see that growing, yeah, markets could continue to go higher. The fact that these markets, especially when I say market, I'm talking about S&P 500, and S&P 500 is market cap weighted. The biggest companies in the S&P 500 are all tech related stuff, right? Call it these magnificent seven companies. They're all tech related. All have been buoyed by the AI tailwind. And if that tailwind continue, yeah, S&P 500 will continue to do good. Now, the other part of the economy, which is not related to AI, or the companies that are not in the Magnificent Seven, right? That hasn't been performing as well. So let me just fire up my think or same. And if you look at a equal cap weighted, right? Not S&P, not SPY, but if you look at RSP, I don't think RSP has done as well as what. Let's look at RSP. Equal cap weighted year to date, 7%. Not bad. I thought probably it would be less, but not bad. But not as great as 17%, which is what S&P 500 had done. By the way, a question for anyone who do ETFs. Um, RSP is one ETF for S&P 500 equal weight. Do you know of any other ETF? RSP doesn't have a good option on volume on it. I've been trying to look for something that I can use options on, but RSPs, if you look at RSP, the option pricing are so wide that it's almost untradeable. Anyone else trading any equal weighted other ETF which has got better liquidity in option market? If you do, please put it in chat. I'm on lookout for something to trade on the equal weighted side. Ramesh's next would be robots from Musk. Yeah, we'll wait. That's where I would say one half of the valuation of Tesla is coming from robots. Probably other half is a robot taxi, which is also kind of a robot, right? We're gonna get a robot taxis. We're gonna get Optimus. That's all drive the valuation for Tesla is. Qualcomm, Marvell are back in the play. Did Qualcomm not announce some chips recently? Right? I think that's where the Qualcomm came in, and Marvell probably came in a play, I guess, because of Amazon. MRVL. What happened to Marvell? Did they have earnings recently or what? No, they did not have earnings. They had their earnings a while ago. I think this jump may have been because of Amazon. because Amazon does use Marvel for some of their chips. I don't know if those are Graviton chips or their AI related chips, but they do have a play. Marvel does have a play along with Amazon. So Amazon stock was up like probably the best in a single day gain in many years. It was up like 10-11% or something. So Amazon, and I guess that might have also pushed Marvel a little higher. But I don't own Marvel. I've never owned it. Don't have much details around them. All right, let's look at the sector wise. So no surprises here. IT and the communication services are up almost 25% plus. So if you own some of these tech companies, which constitute these two sectors, communications and information tech, would have been pretty good. Great for a portfolio. Even if you don't own these individual companies, even if you just own S&P 500, you're still doing great, right? 16%. Not bad. After getting 2 consecutive years of 20% plus, we are still at 16%. Right? The surprise, which for this year, and I think maybe that was also for the last year, which we generally don't see, is utilities and the industrial sector. Like utilities, you generally see at like bottom 3, 4 sectors for every year, but gosh, this year utilities has been up and it's like top 4, top 3, top 4 sectors. The story around utility is all about power, the power generation to for us and for the companies, these AI companies, to meet their goals, they will need gazillion watts of power, which we don't have, and a lot of investments um, will go into utility, and that's what is propping up the whole utility sector. Right? The need for power generation, which we'll need for these whole data centers, which are hugely power hungry. That is what driving up the utility sector as well as industrial sector too. Right? You just don't need the chips. You need the cooling systems. You need the connection. You need cabling. You need wire. You need electrical switches. You need the whole industrial sector to even construct these data centers. So all, I would say all top 4 are all driven by AI. AI is the next tailwind. AI is for driving the markets forward. So might seem little bubblicious, maybe not. Last week we talked about, and I gave you viewpoint from both sides in terms of, is AI in bubble? We are seeing these hundreds and billions of dollars of investments being committed, right? The other, and is this going to be over investment? No. These are big companies, have decent cash flows. Sam, you have your hand up. Yeah.
Yeah, I mean,
Go
AI
ahead.
can't even get answers right, on these core type questions. I mean, I have to argue with them that my facts are correct. I mean, how are they going to, how's your plane ride?
So,
It's going to crash.
so we are not even there yet. So only thing which I think the use case on the AI stuff which is working, where you can get meaningful economic benefit, is around the coding. Right? Even I struggle sometimes. I'll ask them questions and they will say, I asked some questions around something that happened this week, and I asked Gemini and couldn't answer it. I'm like, what the heck? Sometimes you will answer it, sometimes they won't answer it. But the coding stuff has been the use case, which I think is giving real benefits to the technology companies. But to the non-tech companies, to the general economy companies, we have yet to see the benefits of AI accrue to them, right? That doesn't mean that there are no benefits, just that we haven't yet seen those, either the adoption and the benefits for other companies. There are companies that have been using it, in a customizable way, like what Palantir has been doing for individual, companies, and they have seen some benefits, but over a larger economy, I think it will still take some time. Sachin is saying AI is an excuse to build infrastructure like railways in 1800s. It may not be ROI for everyone. Need to be built for long term. Anyways, we have seen this, Sachin, and this happens in every time we have a revolutionary technology. Right? Even I'll go before 1800s, canals. You go and look at the history of the markets. The bubbles came during for the transportation using waterways as a means of transportation. Canals were built. The stock prices of the companies that were digging canals were like through the roof. Then came railways. Then we have seen during even during the industrial sector we had, then we had during the space exploration, right? Every no Before space was electronics in US. Everything, anything company ended with Onyx had their share price jump, right? And then we had Nifty 50, then we had a internet, and then we had a for a small duration we also had the blockchain companies in 2017. These bubbles will always be there. The question is, this is life-changing technology, but it will be life-changing, will become life-changing later on for all the consumers, and some few companies will survive from the initial euphoria. Many companies will die, but if we don't know which one will survive, which one will die, so as a company, you got to play the game. You can't just say, you know what, I'm gonna sit out of it, because some company you may become irrelevant. So companies are still playing the game because the stakes are so high. If you figure out AGI, you become a platform for the AI computing, as Jensen Wong would like to put in, then there is a trillions of dollars to be made. And especially the companies that lost mobile revolution, that lost the mobile operating systems, etc. Companies like Facebook, Microsoft lost search revolution, they lost mobile revolution. They don't want to lose this, so they're gonna go all in, and that's what we are seeing, so much of our investments being committed. What we don't know, I think everyone, you talk to anyone in the markets, they'll know that this will be a bubble, or maybe this is a bubble. But what we don't know is how big this bubble will become before it bursts. So you may want to get out of the market or get out of these companies today. Maybe they'll go up another 100%, 200% before they actually burst, right? So I think as an individual, we have to make a decision what's best for our portfolio. And if you want to stay in this game, you could, but I don't think there is a one answer that will fit everyone. And and I think there are comments on both sides of the house saying why this is a bubble, why this is not a bubble. Hey, internet companies were just science projects. They had no revenues, whereas the companies that we are talking about right now, which are investing, have generate so much a cash flow that they don't know what to do with that cash flow. Now they got an opportunity to invest in it, right? So there are different companies. Asif says, sign up bubble, my tax consultant sending unsolicited pre-IPO funding syndication deal. I'm getting two. Yesterday there was an email from my tax guy. Now that tax guy has become SPV owner, or I don't know, maybe it's a funnel towards SPV. It's a second or third email which I got I think yesterday I got an email for SpaceX. And that's why I don't want to invest in this private stuff. You don't know how much there may be a bigger bubble brewing in the private side. We have seen what's happening on the private equity or the private credit, but you only get to know and this it will crumble if there are cracks in the market. Right? Anyway, I think the discussion around bubble will be never ending because there are arguments on both sides. We just need to figure out how you want to manage your portfolio so you can survive through it. For me, the most important thing is to just survive. Right? Over long term, markets will, do go higher. But I just want to make sure I survive whatever is coming next. If that means if I have to take some money out and not, grow portfolio with along with the bubble, so be it. Who cares? Right? So you have to figure out what works for you. If you want to be in this, fine. We have no idea how long this will go, and maybe there is no bubble. Maybe we are still sitting in 1996. Like Dan Ives would like to say, right? Hey, the party has just started. Right? We are 1 a.m. in the party that will go continue till 9 a.m. Do you want to leave the party at 1 a.m.? The party hasn't even, hasn't even, is not even in the top gear yet. You want to leave the party right now? Right? We don't know. So that is why I think everyone has to figure out for themselves how they want to be invested in the market. Anyway, looking at a weekly performance, right? Nvidia up, like if I look at an overall market side, the tech companies obviously they reported results, so they are higher. But what consumer staples have been pretty weak this week, and I can understand when the so-called little more higher beta or so-called riskier so-called growth companies, when the money move into growth companies, then it comes out of little more stable sector like consumer staples, etc. So staples and in red. Only notable thing that we see on the tech side, which did not, from a stock perspective, didn't perform well, is the Meta. Meta is down almost 12%. Right? Google is up 8% for the week. Nvidia is up 8.7%. This is after all the GTC and the flurry of deals that Jensen Huang has done in Asia. Broadcom is up 4.38%. I guess Apple is up as well. Right? Apple stock didn't do anything for almost the whole year, and now Apple is where is Apple stock for the year? Let's look at Apple. It's up 11% for the year. Right? It had done almost nothing. This start from it almost done nothing till the middle of October, and then all the gains in the Apple for the year have come in last 15 days. Right? But yeah, I mean that's pushed the markets to a new all-time highs. If you believe in the street estimates, people are still bullish that the market S&P might go to 7,000. Right? So that means there's still a little more legs to the market. I don't know, but some bullish participants from the street, they are saying that it might go to 7,000. So for next 2 months, what's in store? Could we get Santa Claus rally? Generally, the Q4 is bullish for the markets. I don't have a chart right now, but I think earlier we looked at in terms of how many times the December or the last quarter has been green. Right? It's more than 50%, maybe probably more, 3/4 of the time maybe. So that's what is called generally, hey, we might get a Santa Claus rally. Number one, so that's a seasonal factor. Number two, if you are a fund manager who've been lagging S&P 500 because you didn't own some of these, mega tech companies, or you didn't own companies like Palantir in your portfolio, you didn't own companies like some of the storage companies, like Who used to own like Western Digital and all that stuff? Like these companies were, I never owned it, but now these companies over the last 3 months are up like 200%. And if you are those fund managers who have not performed, you might be chasing the performance. You might want to just buy in and get some of those marquee names. Third, there is still $7 trillion sitting on the sideline. And we know that Fed is going to reduce the interest rates. So the money market fund rates will come down. Maybe not December, but we will eventually get some rate cuts, right? We're going to get a couple of rate cuts even in 2026. So that money probably will come to market searching for some yields. I mean, right now you can get 4.5% in your money market fund, or even if you go for a 10-year notes, it's close to 4%, which is completely risk-free because it's US government 10-year bonds, right? But once the Fed starts to decrease the interest rate and the market reprices there's 10 years or T-bills will come down, that money will start moving, searching for another additional yield. And investors are still looking bullish. So this is I picked up like yesterday a II investors sentiment. 44% are still feeling bullish. So maybe we could go higher. Again, I'm not saying that we will go higher. I have no idea where the markets will go. I don't have any crystal ball. We will take it as it comes. But panicking out or selling out when you really don't, only for the reason you think the markets are high, hasn't really turned out well for investors. So my game is still the same. Manage your deltas of your portfolio. If I see that if I'm losing too many of our deltas, and sorry for those who are purely stock, this might be a new term for you, but those who trade options, you will understand. I just look at overall deltas of the portfolio and want to see how much deltas I want to hold at where the market is and just manage it. Rather than trying to get scared or get out of the market, just manage the risk in your portfolio. Shri has given us some takers for equal weighted. Shri, I'll thank you for. I'll look at this. I'm looking for something which is a lot more with option liquidity. I mean, RSP I knew, but I'm not sure about the others. Asif is asking, what are your thoughts on where to invest, park the percent of funds one wants to take out during this meltdown? So again, we looked at some of the fixed instruments, right? So if you want to go, you can go it in want to park it for the short term, you can park it in T-bills or ETF, which is equivalent to T-bills. Sorry, the ETFs, which basically invest in a short duration T-bills, which is what I do is ICSH. ICSH has a pretty decent yield, and basically it doesn't have the long-term impact for the changes. So right now it's giving you 4.4%, 4.48% yield. So if I have a cash, let's say my covered call got assigned or I sold some shares, I'll just move it to ICSH. If you want to have a little longer durations, you can look at your bonds. There are even now you can get maybe around 6% yield on some corporate bonds. I'm like Meta recently came up. They issued $25 billion bonds, and I think the coupon rate that they are paying is around 6% plus. Don't quote me. I think I heard somewhere. And if you want to buy those Meta bonds, probably it will trade in the secondary market, right? So you can buy those like 6%. And Meta, we're not talking about a fly by night company. We're not talking about a company that is having difficulty in generating revenue or profits. We're talking about Meta here, right? 6%, decent one. So I think on the corporate bonds, you can get 6-7%. It all depends on how far on the risk side you want to go. If you want to go on the junk side, you might get 7-8% on the fixed income, right? HYG is your high yield bond, right? Which does include some of those low investment grade bonds. It is giving 5.6%. So depending on how much risk you want to take or what's the duration for which you want to hold the cash, there are many instruments available. My preferred right now is ICSH because I don't want to take any interest rate risk for going longer term on the money that I may want to deploy back. I do have a long-term bond exposure through TLT, but that's because I always held TLT. But for the temporary cash moving in and out, I use ICSH.
The Vivek, ICSH is not in it's in corporate bonds, right? Not treasury bonds, I think.
No, it is got a treasury plus a little bit of a corporate. So if you look into the ICSH, I think majority of it is in treasury. Plus, it is enabled to do little more than treasury because it also has some corporate bonds in it.
I see.
It's a combination of both.
Got it. Okay.
And then this has been my vehicle for parking the cash for temporary purposes.
And what is the NAV for that? I mean, sorry, the par value, is it $50?
I mean, I don't know what the par value would be because this is an ETF, right? I don't know when the par value would have been, but it's an ETF generates a yield around 4.8%, which is decent enough, right? So now you will see this because once they give the dividend, then it will again start from below. It will fall down.
So they compute a daily net asset value based on the bond values every day. And that's what computes as, I think, $50 or close to something like that.
Yeah. So it will start around 50, 51, 50 point something, and then will accumulate and then will again go down. Yeah, I mean, I've never paid that much attention. I'm like, I need to park some cash. I'll put it in an ICSH.
Why not use, I suggest people who want to minimize taxes, the California mini bond funds. They are actually yielding better on a net tax basis.
Yeah, sure. I mean, I've not looked at it. There are, muni bond, you don't pay any taxes. But I don't know in terms of, you need to find out which is the good rated muni bonds.
No. Bond fund. California mini bond funds are there.
Okay.
It's like your,
So is that also have the same tax advantage
CMF.
as the municipal bonds?
So look at something called CMF. I haven't used CMF for 10 years, but I have Vanguard's California mini bond funds. And on a net tax basis, it depends on a tax bracket, of course.
Yeah. No, sometimes I see like the underlying instrument is it's tax advantage, but when you put it in an ETF wrapper, etc., or a different wrapper, then it is not tax advantage. I just wanted to make sure that this ETF has the same taxable treatment as if you're investing in a muni bond. I'm not saying
it is because there are two components, right? There's a coupon, which is the income side, which is tax deductible. But of course, if you get a capital gain on the ETF price when you sell it, then you'll be taxed.
Got it. All right. Okay. Sorry, is asking about market goes up in Q4. Does it go down in Q1 of the next year? I have no idea. I mean, if I had a crystal ball, I'll be sitting on a beach and drinking some nice pina colada. Why would I be spending my time in analyzing the companies? Okay. Again, the question is, I'm not managing it for a quarter-to-quarter basis anyway. Like, if looking to buy stocks for long term, is it better now or wait till the next year? It's hard to predict. Yeah. If you have money that you don't need it for next 3 years, that's mine. That's my style. If I need something that I need for next 3 years, I will not be putting it in the market. But that's how I am. I'm a very conservative or low risk profile investor. But I have other responsibilities as well. But If you have a money that you can spare, you don't need it for the next few years, it should be in the market, right? And I don't know where the market will go. And of course, it depends on what's our outlook you have, right? You're looking for return for next 5 years, probably then don't put in the market. You never know what market goes up in 5 years. Like 75% of the time market goes up after a 5 year duration, but 100 of 20-year duration, there's never been a 20-year where the markets are not returned positive, right? But in 5 year, yeah, there could be 25% of the time when you have those lost 5 years.
What about market timing based on sectors?
I
For
don't,
example,
I've seen great market timers on YouTubes and the Twitters and maybe in these meetups, that the real investors, if you hear them, they can't time the market. So I'm like, I'm not even trying to time the market.
And as a market timer, you'll already right once. Right?
Yeah. But that's sometimes that's it's very difficult to separate the luck from the skill.
well,
If I listen to all the good investors, those who made money over long term, and not like in one market, but like talk about Howard Marks or
so
Warren
like
Buffett.
right now, for example,
Or
in the last several months, can we sense that, hey, the tech sector is in a favorable position, like planets are lined up for tech sector, then why not be kind of market timed into that sector?
if you can time my market, great, go ahead. I cannot, and that's why I stay diversified. I mean, lot of great market timers lost their share during the .com.
Yeah, but you will have
Lot of
plenty of time to get the signals that, hey, it
we
is
think
ending.
we think that's a game that I don't play. You want to go ahead, it's your money, do what you want to. I don't think I can do that.
Vivek,
Yeah.
considering market timing, 20 years ago, I misinterpreted it. My mom said, don't market time. So when HP, Hewlett Packard, the one company was at 40 and going up, and had Mark Hurd as CEO, I threw a bunch of money in it, and then Mark Hurd was fired. And so market timing and buying stock is kind of different.
Yeah. I've not seen any great investor saying that they are able to time the market. Plain and simple. I used to think that I will be able to time the market. I used to try to play that game earlier in my investing journey. The more I spend time in the market, I realize, oh, come on, it's so difficult. So I'm like, okay, you know what? I don't even want to play the game.
I mean, it's nearly impossible to
Exactly.
consistently time the market every time, right?
Yeah, you
You
could be
might
lucky
have
once.
you might be lucky a few times, right?
Yeah.
Luck might be in a favor, but if you're, it's like walking into a casino, right? I mean, there's always a beginner's luck. You basically win a few times, but the longer you stay in the casino, your luck runs out,
Yeah.
right?
And
So it's the same thing with markets.
we'll talk about one person who again tweeted, I think after 2 years, and he's like one of the has a very big following because he earned his credentials in 2008, but after
Now,
that,
are you talking about the guy who went short, right?
yeah. So
Yeah,
I
but
do have a tweet from him. I do have a tweet from
yeah. I mean, but he's been wrong so many times in
so
the
many
last
times. Exactly.
few years, right?
Yeah, exactly.
And he's been making losses. So yeah, he is pretty much one hit wonder from 2008,
Yeah.
right? So
And unfortunately, us investors are behaviorally like we find someone who has made tons of money, especially by being, in and by being contrarian, we kind of put them on pedestal. We did the same thing with Cathy Wood in 2021. We did the same thing with Mike Wilson in 2022. We did the same thing with Tom Lee in 2023. Right now, Dan Ives, right? We have seen these characters. If we go back into the history of the markets, we will always find some analysts, some fund managers who we will go and treat them like demigods. will listen and latch on to every word that they have to say. But we need to find someone who's been there consistently, right? There are very few such people. Because mathematically, it is impossible. I wouldn't say mathematically, but the with markets, it's impossible for any fund manager to be on the top year after year after year. You will have to take a risk which are more than the market would generally offer if you want to be in the top percentile. And there will be years in which taking those risks will just wipe you out. So, and I think I shared the numbers from some studies around the fund managers. There's a fund man, and who was it? This Dave Rubenstein told, or was it Howard Marks? Right. So the fund manager throughout its life has been from 27 to 47 or 25 to 50 percentile, right? But over the long period, over 20, 30 years period, they've been 4 percentile. Because what happened? The ones who were in the top took a risk, which when the tide turned around, blew up. So if you want to focus on 1 year, 2 year, 5 year, maybe go ahead and do it. I want to look for the next 20, 30 years. Right? So I don't want to even play the games of trying to time the market. Or let's say, now let's load up into this particular sector because this is going to go higher. I never know when the air will come out of it. Right? 2021 SPACs were all the rage, right? Chamath and whatnot. You could think that you will figure out when to get out of it. A lot of people lost their shirt on those SPACs. Right? Anyway, coming back to this, so markets are all-time high. We're looking at a valuation which also looked a little scary, right? Look at a CAPE ratio. It's like now hitting 41, almost as close to what it was in .com bubble. Earnings yield is now 3.15. Right? So these are the things which matter. Why should I invest when I can make more? If I just look from a business perspective, the businesses on S&P 500 collectively only earn 3.15%. Damn, I can put that money in the treasuries or a 10-year bond and make more than that. Why do you want to take a stock market risk? That's a question that you need to answer for yourself. Maybe we will continue to, value these companies higher and higher because of the future growth, right? This is 3.15 is as of today. It doesn't tell you about the future. This is like earnings as of today, or maybe whatever the latest quarter is. We may be willing to pay up, and this is what might be happening. We are willing to pay up more, assuming a lot of money coming on the future side. And this always happens. So be careful. Right? End of the day, you have to decide how much of a risk you want to take in your portfolio. I can't tell you for you. And I don't think anyone can tell you what you should be doing it. You need to understand what amount of risk you are comfortable with. The markets are definitely not available at a reasonable price. But that doesn't mean that the market will correct or you go short on it. Right?
But there are some stocks which are available at below reasonable price.
Sure. I'm talking about overall market. There are stocks which are egregiously priced. There are stocks which probably are available below market. Google was one of them. At the start of a year when everyone was dunking on Google, saying the search is dead and all that stuff. I don't think Google is now available at that anyway. It was available at less than 20 PE. Right? Google was at that point of time. No, it is not. Right. Amazon again of the top 7. Amazon was one of the cheaper ones. I didn't look at like after this run up where it is. Again, as long as there is no structural change that we see, I think the bubble continues to become big and big. So next week earnings. What I would be focusing on is Monday, of course, after market close, we have a big Palantir, one of a very retail favorite stock. Used to be my favorite at $7 when we talked about it, but became less and less favorite as it moved beyond $60. In my head, I just can't, looking at the business, how much the business they are doing and the margin they are doing, I can't justify where the price is. And this week, Palantir hit $200. So I have my last lot of Palantir still available with me, and I have a covered call at 185. I think rolled it a couple of, maybe a couple of times, managed it by selling a put against it. Probably have around $10 overall premium. I'm not gonna defend it. If it gets called away because the stock is trading at 200, 210, 240, 250, I don't know where it will go, let it be called away, right? This is one stock I'll call it as not at egregiously priced, right? Not over expensive. I'm okay to hold overvalued stocks, but this to me seems to be an egregiously priced. I'm not. We have seen this journey from $7 all the way to now 200. So we'll see what they come up with on Monday. Then on Tuesday, I got Uber and Shopify, and then Arista and Pinterest. And on Thursday, I got a Trade Desk and Airbnb. Any other stocks? What do you guys are interested in? I'm gonna look
So
at these because I own these in my portfolio.
I have Astera Labs coming on
Astera Labs.
Tuesday. It has
Yeah, Astera
rallied.
Labs is on
Yeah,
Tuesday.
it says in November 4, no?
Yeah, it's
Yes.
on Tuesday after market.
Yeah.
Yeah.
So I guess if just to summarize, like it had gotten a big drawdown of about 30% about in the last several weeks, but in the last few days it's rallied up more than 20%. So I think it kind of heralds good earnings coming. Only my opinion.
Yeah, no, I'm not owned this company. So I don't know. A-Lab.
It's right next to Santa Clara.
Yeah. So
Yeah, it
oh,
announced gangbuster earnings
it's been a
growth
new
and revenue
IPO.
growth last time.
It's a new IPO company. Doesn't have
Yeah,
anything.
so this is the amazing thing that they are profitable. You know, these companies which become IPO become profitable very rapidly, and and they're growing their earnings and revenues to like three digits. I think 200% something in the last quarter they reported, and surprises were pretty strong too.
Yeah,
So
we'll see. I mean, I've not owned this
yeah, I'm a
company,
big believer.
but yeah, they've been diluting like hell.
How do you see that?
Share change year over year, 137%. So maybe they did a IPO in 2024, then maybe another secondary offering here, because the share count grew like crazy. So they need money. Either you raise debt or you sell equity to grow this revenue. And again, I don't know. I'm just looked at here for the first time. I'm looking at, okay, even if they are growing it, they're also diluting their shareholders. They double their share count in trailing 12 months, right? Not interested too much. I mean, it's so got only 3 years of history. Looks like the model is not that scalable. It's not like you can copy paste and create a code. Probably this company is on is
It's
like a data center, some connect.
No, it's basically in the to connect these high-speed GPUs, you need
Yeah,
various connectivity,
yeah,
and so some of it is kind of like older style Ethernet based, but
got it.
it's high-speed Ethernet and all that. And so in any ways, like they will be needed, even if So what the story has been is like NVIDIA and all are coming out with faster NVLinks, which is basically going to marginalize this company. But in my opinion, if the pie is growing so rapidly, they cannot be kind of completely, left high and dry.
Anyway, so I have a Arista Networks, which is much better as a business perspective. If you just look at the numbers, and again, Arista is also in the similar way in which They basically put a network connections, but AI related is their new business, and they have actually done better than what they had told the street around their AI revenue projections. But anyway,
I also have Arista and
yeah,
Pinterest.
I think that's much better business. Again, A Lab has got only 3 years of history, so they have a lot more to, you know, probably they will become a great business. Right now, they're in a growth phase, so I don't want to ding it saying, "Hey, your margins, etc." So hey, you're only in 3 years. I don't know when this company founded, but they've been IPO very recently. Looks like. Uh, what else? Do you view Tesla somewhat like an ETF in that you are diversified being in it as a stock position? Tesla, uh, Barbara, do you view Tesla somewhat like an ETF? No, Tesla for me is that's an individual stock position. And I'll talk about my top 15 positions because we just finished a month. And at the end of a month, I always share what's my top 15. So you'll see what my top 15s are. So Druckenmiller record is pretty flawless. Yeah, he's the one. But I mean, I can't be stand Druckenmiller. Let me put it that way. He trades really different, and he's a big trader. They get in and out of positions, and they trade everything, macro, micro, right? I don't think I'm that capable. Johnson, we want Foresight and stock market get elected to Congress from either party. Oh, there is a Nancy Pelosi ETF. Maybe you can just buy that ETF. Couple of AMD holders. The race is which is Ferrari. Ferrari got little crushed because I think they had their negative operating earnings. Open Door. I don't know. Open Door has been retail favorite. So you want to try that swing trade on Open Door, get in and out, maybe. But I am still staying away from Open Door because the business model, I don't know, they've been spinning a lot of stories, but how the AI is going to change the business model seems to be very difficult. Alfred says, last year I asked to do analysis on A Lab. You did back. I did on A Lab? I probably don't I must have just looked at the financial numbers because I don't think I actually have a investment thesis or actually document created for A Lab. Because I've never, no, I don't see I have a document for A Lab. So might have just looked at the number. A Lab price to sales greater than 50. I mean, it's too young a company. If you think price to sales greater than 50 is a problem, then the Palantir has got a much bigger problem. That's price to sales is maybe 100 or something. I won't be surprised if it is more than 100. Have you followed Zcash? It's also traded as Zcash. No, I don't own Zcash. Now we're talking around the crypto side. No, Zcash, I know it has gone up. I don't know what's driving it. Lot more sudden interest on the privacy coins, etc. Maybe not, but no, I don't trade Zcash. Anyway, so here's a portfolio Pizza long stock holdings breakup as of end of yesterday. So nothing much change from I would say September or October, except I think Tesla moved out and IWM is in. That's the only things that have changed. I'll give you a minute to look at it, ask any questions that you may have. Because next time you're gonna see this pizza will be after end of November. Also, I'll sip some water. All good.
I have a question. Like, how do you actually purchase Bitcoin? I remember seeing it in one of your pizza slides.
Pizza slice, I want a Bitcoin.
I'm like,
Now, so if you want to buy the Bitcoin, you can go and buy it on crypto exchanges. You got a Gemini, US most popular is Coinbase. You can go and open an account in Coinbase, transfer your dollars over there, and then you can buy Bitcoin, right? Now, after January 2024, now we have ETFs that are based on Bitcoin, spot Bitcoin, right? We have had a ETF based on Bitcoin futures since 2017, but since 2024 Jan, we also have a ETFs based on spot Bitcoin. So if you don't want to deal with the Bitcoin itself, which, hey, if it get hacked, if my keys get hacked, let's say, or if Coinbase get hacked and I lose it, then you can just buy an ETF. Okay. So, so there are many ETFs. My preferred vehicle for ETF is IBIT, which is IBIT is ETF from BlackRock that has been the most successful ETF in the history of ETFs. That's got almost $100 billion asset under management. And I use that. If I want to trade in Bitcoin, if I want to get economic exposure to Bitcoin, obviously. But you don't have self-sovereignty, right? If you're that libertarian or coming from, I want to be have my own key so that government can't confiscate and all that stuff, then you better own a Bitcoin and move into your own hardware wallet. But if you don't have that concern, then
no, I think it's for like a simple vanilla flavor, like just need an exposure without any complexity.
Yeah, if you want an exposure to the price movements of Bitcoin, you can do it with any of these spot-based ETFs. Don't go for the future-based, but go for the spot-based.
Okay, perfect. Thank you.
IBIT is there, FBTC is there. There are many.
Okay. Yeah.
Cool.
And
Ravi, are you not holding AMD, Palantir, TSM? I don't have any AMD in my portfolio, but I do have Palantir and TSM, but they fell off the top 15, I guess. That's why they're not here.
And Vivek, I imagine you sell options on these positions. So
yeah,
given where the market is right now, so you basically, I mean, do you sort of come up with, like, if you think it's kind of high enough, do you come up with a relatively delta neutral sort of trade? And
not always, right? So when I look at it right now, I do want to hold some positive deltas. So let's say then I will sell options, like say Google. I have a trade which is a put spread and a covered call all combined together, right? So I will figure out in terms of what's my outlook towards that stock is, and then I will figure out, how do I want to play with it. So there is no one size fit all. So let me look at a Google. Google, I have a 19 December expiration, 330 call, and 265, 245 put spread. So that means Google goes beyond 265. I will be able to buy a few, and which I'm okay with because I sold some Google at 289, 290. So I will refill the tank. But if it continues to go higher and go up to like 330, which would be another, what, 10, 15% higher from where it currently is, it's at 281, right? So another $50 higher in December 19, which is almost 17, 18%. Having the run which is already had, which is like 48%. Yeah, I'll be okay to sell some portion of it. So that's how I look at my trades, right? So I cannot give you one set answer for how would I, do my, in some cases where I'm, okay to own, in Google case, I did a put spread because I wanted to contain my buying power if the market, sells off, because the markets are at all-time high.
Yeah.
But if let's say market corrects 5%, then I'll be probably doing a strangle in that case, or maybe doing a naked put. Right?
Right.
The idea is I want to buy premium and reduce the cost basis of my owning of my shares, right? And if I
Sure.
look at a Google, hold on, GOOGL. So Google I've owned for, I mean, I only, or let the data refresh. I can come back to it later.
So are you basically owning like stocks, like
Yes,
long term,
yes,
right?
yeah.
Holding and these are, mostly sort of like tech and SPY and QQQ, right? Mostly on
So
the tech side, right?
yeah,
So
these are
do
all.
you basically like own them and you sell covered calls, you buy some protection, through your put spread, and if there is a pullback, then you basically sell some puts. Is that kind of your strategy overall?
So I do want to own these stocks for long, but yes, I will sell for for hedging. I generally don't buy put spread because that hasn't worked out in the long term. You have to time the market for your put spread
So
to
when you
really
said put
perform.
spread, you're basically then saying
That was my sell.
credit put spread.
That was the credit put spread. Yes.
Okay.
So for example, right now, all my hedging trades would be around naked call selling on QQQ and SPYs, right? So I probably own.
Yeah. So you're basically, you're basically selling, calls because you own these assets, right?
Yes.
So you're basically kind of doing, wheeling, wheel strategy, right?
No.
So do you do like day trade or swing trade, get into new tickers
No.
for like, 45 days or less?
Not necessarily. The only thing which I'll get is not individual ticker. I will only trade in if I have built my thesis around it. But let's say from a diversification perspective, hey, I want to own something on the materials. I will probably go for an ETF,
Okay.
right? And then
You don't
maybe
you don't
sell
do
it.
SPX, you don't do indexes stuff, right? You don't.
Indexes consume a lot of buying. I've done indexes. I mean, I
Mhm.
do XSP. So I have a short calls on XSP,
Okay.
right? I have a short calls on XSP, short calls on SPY, QQQ. So these are so remember earlier mentioned, right? The delta management.
Yeah.
So daily basis, the things which I do will be looked at. Okay, if I got more deltas because the market sold off, and if I'm not comfortable with that, I will go ahead and sell some calls on QQQ or SPY or XSP.
Yeah. I mean, the only reason I asked is because you said that you do options
Yeah.
quite a bit. So, but you don't do 0DT
No, I don't
or
really do.
1DT, SPX or other
No.
stuff, right? You
So
don't.
yeah, my closest DTEs would be a weekly one that also just a hedging perspective, calls on XSP or QQQs, etc. The other thing which I do on a weekly basis is on these Bitcoin ETFs, IBIT. You can get some decent premium. Otherwise, let's say the cover calls, etc., or let's triangle straddle, whatever I want to sell against my positions, those are mostly the monthly ones. Because you sometimes on those weeklies you don't get enough. I mean, you don't have tighter markets. Number two, you are also exposed to a lot of a gamma risk if you go a shorter duration, and that means you need to watch your positions really closely.
Do you mean SPX or other tickers?
Even for
Which one?
others, right? The closer you get to your expiration, your gamma risk start to increase, right? And
Yeah.
that means you need to be watching your position very carefully. And I don't want to put myself where in that situation. I want a little more of my freedom. Like yesterday, in the morning, I went out for a hike. Right? I can't do that if I have a zero DTE position, right? So morning, I went on a hike. It was nice weather. I left at around 8:45, came back around 10:45. It was a nice 6-7 miles of a hike I did without worrying about what's happening to my positions. So
So basically, you're mostly conservative.
Yeah, I'm a
Rest.
conservative.
Okay.
Yeah,
Okay.
yeah,
Got it. Okay.
yeah.
I'm just trying to sort of look at based on your portfolio, the kind of trading or investing or
Correct.
things you like. Okay.
So the reason I became a full-time investor is to get control on my calendar. I don't want a now market to become my new boss and forces me to sit in front of a computer for watching it minute by
Yeah.
minute chart.
Yeah. I mean that's fair, right? I mean, there's always there's also always a risk right now, especially with zero DT SPX, right?
Yeah,
I mean, all it takes sometimes is a single tweet, and you'll have like a 40 to 6 points move on SPX, right? Which could be
yeah.
pretty brutal on for your trade if you're in the wrong direction, basically.
Correct. So
Vivek, sorry.
yeah, go ahead.
Vivek, your portfolio doesn't add up to 100%. So
This is
just
top
want to-
15.
Okay.
Oh, sorry,
Okay.
this
Then you
is
have a
top
bunch of
15.
other.
This
Okay, got it.
is top 15.
Yeah.
Yeah.
Okay. So you have a bunch of other positions in smaller companies.
Yeah, I have some dust positions which are like 0.5%, or I have there because there are some like old ones which there are some moonshots. So if I I'll tell you in terms of my construction is around 60%. Hold on, let me sure that with where's the pivot portfolio. Just give me a moment. Okay, we'll probably run out of time, so we'll have to.
That's fine.
Okay, so yeah, so right now my 70% is in my core holdings. Core I define as a good standard businesses or the ETFs. So I don't have an individual stock exposure to it, right? Then 25% portfolio is in growth companies, and then close to 5% is in moonshots, right?
Okay.
Which is a, hey, it's a probably will go to zero. Maybe one of them will work out, who knows, right? So that's how I will.
Yeah.
But
So what you have shown here is growth and stable, right? In this chart.
No, in this chart is the top 15. All of them I think are core, because I'll not have anything which is growth. Probably have not, nothing is 2%. None of the growth is in 2%. These all are part of my core portfolios.
Okay. So one of the it would be good to explore the moonshots, right? Also, just because even I've got a similar mindset, right? I've put majority in stable growth, what have you, right? Then I try to experiment with some moonshots. So maybe it would be worth it to have a discussion on moonshots.
Yeah, so I think I did talk about it. So here's the moonshot one. And for whatever reason, people always become interested in moonshot because they want to know what's the next 10x. I have no idea what's the next 10x is.
For sure. Yeah.
Right. So this is ARKB, which is Bitcoin ETF. This is Jumia Technologies, right? This is the Africa-based e-commerce player. It was in a range. It was on CNB since 2021 mania. I still own this. I still watch it. They're turning around the business. I'll own it, but it's not easy to build e-commerce business in Africa, right? So it could go down to zero. ETF XYZ, I talked about it when I moved it from a growth to moonshot, because Jack Dorsey, he wants to focus and take this basically ticker for company Square. He wants to basically focus on Bitcoin ecosystem. So I had to move it to the moonshot side of the house. This is BlackBerry. This is IBIT is a Bitcoin ETF. This is Nanox is a medtech company, right? So this is what I have on my moonshots.
Got it. Okay. Thanks.
But the idea is any one of these, if all of them collectively go zero, yeah, I'll lose 5%.
Right. No, that makes sense.
Just helps me from a portfolio positioning perspective that are not overly loaded on the super high growth but super high risky tickers. Okay, growth portfolio. Let me see what I've named as growth. Oh, so Melly is in growth. Oh, because it's on LATAM. So hold on. Okay, so there are many tickers on the growth portfolio. Melly is on it's on LATAM, so that's why still it on the growth portfolio. It's still growing their business like crazy. Shopify, Palantir, Uber, Alibaba, Tesla, Airbnb, PayPal, C Limited, CrowdStrike, Coupang, Trade Desk, Pinterest, Tencent, KWeb is a Chinese ETF. Unity is like an old one still sitting in my portfolio. DocuSign, Neo, Chinese EV, XPeng, Chinese EV, BYD recently opened positions. Rocket Mortgage, Magnite, Teladoc, JD.com, Doximity, Li Auto, Fastly, Fiverr. Some of them are bag holders from a few years. Some of them I am actively tracking and actively bullish about that. But this is my growth, right? So these are top 15. All right, let's move on. Are you holding Coupang? Yeah, Ravi, it's on a growth portfolio, but it's not top 15 position yet. Okay, and let's say if I see one of these growth or moonshot becoming top 15, that'll make me a little nervous because the business hasn't performed as well. That's why it's still in moonshot. But the stock price probably has run up much farther, right? And then I can take some decisions based on that. That is why I started categorizing it in these ways. All right, let's quickly look at some of the other news, then we'll jump into earnings. Jensen Wang during the GTC and then later on during his trip made a lot of announcements, deals with Uber, Nokia. I think there was a question of what do I think about Nokia? Except what's happened with NVIDIA, I think this is just a temporary blip. I'm not too bullish on Nokia just yet. Because they lost the whole mobile game. They are now, I mean, it's still they're building infrastructure for 5G, etc. So probably will still be relevant, but not nearly a growth company that it used to be once. Then they signed deal with SK Hynix. SK Hynix build a high bandwidth memory. They'll buy some NVIDIA shares, signed a deal with Samsung. I think Samsung gonna get some NVIDIA shares, but what I don't know is, did they also sign a deal to make chips for NVIDIA? Right? NVIDIA get most of their chips made from TSMC, but Samsung also have a foundry business. What I don't know is, did they also, are they gonna make chips for NVIDIA or not? Yeah, let me just finish with this one, then I'll come to you. Then we got a deal with Hyundai, and then another, yeah. So a lot of stuff on Korea side, and he was seen drinking. No, he was seen drinking beer with, I think, the Hyundai and the Samsung CEOs, which is what the culture is. Then he came out and asked Korean people, how many of you own NVIDIA shares? A lot of folks, they held up their cell phone showing the NVIDIA shares that they hold. And then he made a comment, that's why Korea is rich. That guy is having ball of a time, man. And why not? Why not? He's earned it. So Jensen is making deals. One thing is for sure. If NVIDIA goes down, it will take a lot of other companies down as well. So he's making sure that he's not the only one, if he's going down, the whole ship is going down. Yeah, he's having the best year. Sorry, someone had a question.
Yeah. NVIDIA, I'm about to put it in the chat, but NVIDIA is providing for Samsung and the Korean National Computing Center.
Competing?
Korea National Computing Center.
Yeah. Yeah, he's providing chips for them. I think some 500,000 chips, something they have committed. Yeah. A lot of vendor financing going on. Yeah, we saw all those OpenAI and basically taking stakes in each other, right? So if I go down, you go down with me. So that's again one of a concern around this whole AI bubble is, have we seen this vendor financing stuff in 2000 also? Right? Yeah, are we seeing similar stuff right now? Another one, Palantir crossed 200. Congratulations if you are Palantir shareholder. Don't ask me why it crossed 200. Oh, we actually closed at 200.47. Its all-time high was 204, right? So don't ask me why. I was bullish on the stock and the business, but I stopped being bullish on the stock way early, right? And the stock continues to go high. Those who were earlier talking about price to sales and were balking on 50 price to sales for Stera Labs, look at Palantir 135. No,
Because it's not just the valuation, which is what you talk about when you say price to sales or PE, but also the implied growth, right? Which have to be balanced together.
see, here's the deal. As a shareholder, you don't get the revenue growth. You get what's left out after you pay your vendors, you pay your employees, you pay to the government, and you pay to your debtors.
That was
Whatever.
true for the 1970s and 80s stock,
No, even
but not in the growth stock world of the last 10
no,
years.
no. So you're talking about the stock price. I'm talking about the business side. Right? That's all come to you. So if it was a great business, yeah, I would overpay for Palantir. What I don't know about Palantir is that, to me, again, that's street used to say that's a consulting company. To me, it does seem like with the case. It's not a software company. It's not that they can grow their revenue 2x and then you can start to have an operating leverage. I haven't seen that yet. That's my concern. The concern is not the stock price. The concern is that the business is not that great, as if the stock price is like a 16% operating margin. I would rather have Microsoft, which is like a 40% plus operating margin. To develop a software, you don't have to develop another copy of a software, you don't have to spend the same amount of a time. Copy, paste, right? Palantir is not that stuff. Maybe they're doing a lot of custom work for individual customer.
Got it.
You can use euphemisms like forward deploy engineer. When I was working on a corporate, we used to call it as a professional services resource. Send an engineer to a customer place. He will work with the customer and do the stuff faster and much better for that specific customer. But the margins are low in those projects because sending an engineer cost us. What
Yes,
bothers me?
professional services, basically.
It's a PS. Yeah, I
The
mean,
same thing.
Yeah, but they've been signing really mega deals. That's the thing.
yeah,
Hundreds of millions
as a
of dollars.
customer, I will love it. As a customer, I will love it. As a business, and I mean, I had it in my previous life. I headed PS organizations. I was like, I was heading, all post sales, so including PS, customer support, and your customer success team. So I know customers will love me to send an engineer, but then I know it's a low margin business for me, right? PS is a low margin business. Product revenue, always the focus is on get as much as product revenue. If from a company perspective, if my PS group revenue become more than 15-20% of overall revenue, that was a concerning for us as a company because it's a low margin business. To me, looking at these margins, come on. Street can say whatever they want, not street. I think the market can do whatever they want to do with the stock price. This is not a business that I want to pay like 200 times sale for such a low margin business. Okay, so that's my concern about it. My concern is that the business is not as software or AI business as what Alex Karp would like to talk. Whatever they build is amazing. I mean, when I looked at when the stock was $7, I'm like, come on, their products are great, but their products are not scalable. Or at least I haven't gotten an evidence, proof that their products are scalable. Right? You can grow your revenue 100%. Who cares? Give it for free to a customer or give it at a cost. Customer will love you for that. Customer will come and give you all the, they'll come in your, your conferences and give you all the, talk great about you because customers are happy. The business side, I'm a little concerned. Anyway, so
Hey, Vivek, just one point, right? You said that the software business, you just make it once and then you can just sell it. I think with the AI paradigm, it's a little different because every query, right, now costs money for the inference.
so
So that could be
yeah.
changing.
So I was talking about the stuff like you do
The
Microsoft
traditional
Office.
SaaS business.
Yeah, the SaaS, right? It doesn't cost you to, and that is why most of the valuations for the software companies were so high because once you cross a threshold, you start to get those operating leverages. You will see revenue growing at 20%, but you will see your operating margin growing at 25%. You start to get those operating leverages.
Yeah, but I'm wondering with the AI model, right? Because now queries could cost money, right? So I think this model may be changing.
But we will have to get to a level wherein you have built your fixed cost enough that any
Yeah.
additional incremental query is not going to incur additional fixed costs. So right?
Yeah.
Yeah. So that even happens on the software side, right? Once you build your software, until then you can't achieve your operating leverage. So, and that is why for any software companies, if you really look at the earlier part of their journey, you will have a low margins because right now your fixed cost is too high and you don't have enough of your customers to defray those fixed costs. But as you grow your business, then you start to see that, hey, my product is stable. I don't want to invest so much and save on the fixed cost or R&D. Then you start to get those operating leverages. I'm not seeing that in Palantir. It's a 17-year-old company. If it was a new company, I'll grant them like 16% margin. Who cares? That's why I said I don't want to ding Astera Labs. It's a new company. Palantir is a 17-year-old company. Have they productized it, whatever they're building? Or is still a professional services? That's a question you need to ask yourself. To me, I've not seen that it is a scalable margin business yet. But hey, it's a retail dividend. It's a very momentum stock, and short period in the markets, 2 year, 3 year, 5 year, it runs on mood and momentum. So why not? The stock is up 200%. And I made money on it. Like let me put it that way. I'm not sad that I own Palantir. I made decent money on it, right? But it is what it is. I don't want to. I have 185 covered call, around $10 of premium on it. Gets called away. It gets called away. So, but you do what you want to do with the stock. You understand the business, and let's say year down the line, the stock corrects. And then you shouldn't be saying, oh, the Wall Street has done this to you. You know what you own, and then you decide how much risk you want to take. Okay. All right. Dr. Burry is back. He tweeted, sometimes you see bubbles, sometimes there's something to do about it. Sometimes the only winning move is to not play. Right. So he other signs of exuberance, I think they talked about is the NVIDIA became the first company to exceed $5 trillion. In 2023, this company was maybe $1 trillion. So in 2 years, it looks like after every quarter or 4 months, it has $1 trillion valuation. Maybe that's a sign of Baba.
Well, all I'll say is that I have worked in this field myself, and only in the last 6 months, I am realizing that this AI stuff is yielding true value. In other words, the reasoning agents are giving far more value to me as a person. And I think it's my opinion. I think the world is only realizing it. And that's where I'll say all I'll say.
Yeah. So I think earlier we talked about the true benefits We haven't even start to see, right?
And especially
So
that in the last 6 months, it's accelerated. That's what people don't get it.
yeah.
Okay. I
Excuse me.
personally work in this field. So what has happened in the last, so we started with what are called queries only, right? Simple questions. But now these things have reasoning capability, meaning like they've implemented so-called chain of thought models and so on. So it's doing 75 queries. Each query gets back, it reasons on it like a human.
So
And so the value that it's delivering, if you ask a question or do things, is far more. And only now people are appreciating it. That's why NVIDIA is getting into so many of these agreements.
oh, oh, yeah. So and again, Nvidia exceeding $5 trillion, I think is still cheaper than where the Palantir is trading.
Oh yeah, for sure.
Because the business,
I go by peg ratio, and Palantir is up north of 3,
yeah,
whereas Nvidia is actually fairly valued at
yeah.
1.
So I think Nvidia was not as richly valued as like $3 trillion or $4 trillion would have you suggest, right? Its forward PE probably was in mid 30s. Right? That's not egregiously overvalued. So that's why I'm probably more bullish on Nvidia at 4 or 4.5 trillion than at Palantir at $400 billion because the business is very different. Anyway,
Wait.
yeah.
Kai-Fu Lee has been throwing AI for the last 13 years.
Sorry, who?
Kai-Fu Lee, Google and Microsoft China Labs. Kai-Fu Lee. Well, anyways, he's been pushing it for the past 13 years.
Yes, I mean, we have seen different forms. Kai Fu Lee. Yeah, I've not heard of this gentleman, but it's all started with big data, machine learning. The paper from Google came many years ago, but now we have start to see the real game changing stuff. And again, so right now, I think that again the majority of benefits are on the coding stuff. So there's some of the stuff that we were talking about, the reasoning. I think Claude, they Anthropic released the new version of Claude, and maybe I read somewhere that like it it coded, figured out what's wrong, and then came back and fixed it. It's like an agent working for 2 hours without any human intervention. That's great.
So I guess I kind of briefly for just 20 minutes heard Jensen Wang speak last week, and I can send out the YouTube link. But it's very informative. If anybody, even who's not into this field, it'll basically tell what is the transformative stuff happening now versus a couple of years ago.
Yeah. And I think I put a message on the Slack group, was it on WhatsApp? So I'm like, after I heard Jensen on GTC, I closed my covered call at lower than my usual profit. Because I thought, okay, there is too much of a tailwinds coming behind Nvidia. But along with these
But
great stuff,
everything, end of the day, everything is tied to GPUs, right? All of this stuff, right?
No,
That's where,
GPs also.
not just
So
GPU.
now yesterday's news, Google is basically 100% utilized on its TPU offerings.
Yeah.
And not only that, some other company is going to basically get TPU access from it.
yeah, I think Anthropic is now
Anthropic is gonna use.
Anthropic is looking at
Yeah.
TPUs, right? That's going to be interesting, right? You know, everyone needs GPUs, and there is a shortage of GPUs, and that's why NVIDIA is like
NVIDIA is brand equity,
the
like
cool kid
IBM.
on the block right now, right?
Yeah. So
But
again,
all it takes sometimes is, for example, another few deep sea kind of models to come out there where basically they can show that they can put some of the stuff out and that you don't really need all these expensive GPUs. Then you'll see like what happened with NVIDIA back, few, I would say 6, 7, whenever it went from 140 to like back to like 100, right? So there, there'll be some, waking up moments, right? So right now it's in the hot seat. So I'd say just, go with the flow.
Yeah,
for
I mean,
individual stuff.
and Nvidia can sell little cheaper. They are like a 60% operating margin, like 55% net profit margin. I think they can afford to take some hit, but obviously the valuation will come down and all the stuff will happen. But to add to another stuff, it's not just GPUs. I think the overall ecosystem that they built, which is because you can't scale up a GPU beyond a certain, you hit your limits of physics. So not just
And
GPU.
what would that be outside of GPUs
We're
from
already
NVIDIA?
hitting the limits of physics because we're getting
NVLink, which connects the
yeah,
various GPUs, CUDA, which is the
the
kind
No,
of
no.
like
software.
So when I say
established.
GPU, okay, fine. The ecosystem, right? But if you
Exactly.
sort
Cannot
of
replace it within several years, and by those in those years, the war would already be won. In the sense, like if you're like an empire builder and trying to
Okay.
go build an empire.
Okay. So we can have probably deeper discussion during the breakout room. Let me just go through earnings because maybe not everyone is interested in getting into the details of CUDA and the other libraries which Mr. Jensen Huang is building. Right. So we can probably talk deeper into our in the breakout rooms.
Yeah, I agree. I think it's too much of into the weeds and too much
Yeah.
of fundamentals, right?
All right, but along with these all great companies, you also see some of the other which are like, yeah, let me just ride the wave. Oklo is one company. They don't have anything, but the stock probably is just going higher because, hey, I can now generate small modular reactors, right? And the 2 years, so Oklo is founded in 2020. They applied to Nuclear Regulatory Commission to say, hey, we want to build a nuclear power plant, and they even failed to pass even the first step of approval. They didn't provide any answers to around the basic safety questions and all that stuff. But now the administration has changed. We made it much easier for businesses to just come and do the stuff, and probably Oklo will get approval, etc. But figure out what's these companies gonna do. Right? If it is just a science project, how much you want to put money behind this science project? There is another company starting with the ticker starting with G or JIT or something like that. I think they had released a paper which say that they can do again as a competitor to Nvidia, they can build a chip which is much better for these workloads and all that. But all they have is just a scientific paper, right? They don't have any chips yet, and the market is like, okay, this going to be the next Nvidia. So there will be I see a lot more froth in these side, peripherals of AI companies, which market is now the market participants, I would say, is now trying to just buy it, thinking that these will be the next Nvidias of the world or TSMs of the world or Googles of the world, right? So you got to be careful in those stocks. Okay. I will skip this one. This is a new report that came out. Maybe we'll use sometime later. China, we all talked about it. Now, another thing which was surprising, AI is lifting also the emerging markets, not just the US market, but if you like trying to diversify yourself, saying, hey, you know what, too much froth on US market because of AI, let me go to emerging markets outside of the US. You buy EEM ticker, which is generally what I use it for getting emerging market exposure. And yeah, this was up almost 5% this month. But this is a report from Bloomberg, is even that ticker is driven mostly by AI. You look at Taiwan Semiconductor, Samsung, Alibaba, they account for almost half of the increase in EEM. Now, what's driving all these three companies is AI. So again, I thought I'm diversifying outside of this, but I should have dug deeper to see what are the constituents. Maybe we'll do it now. TFEEM. What are their holdings? Oops. TSM, Tencent, Alibaba, Samsung, SK Hynix. These all are AI plays. Then you got HDFC Bank, Huawei, I think this is called Foxconn. But these top 4, 5 are all AI plays. So it means I still have AI exposure, even if you own this. And we talk about concentration. One of the bearish theses is, oh, these Mag 7s are too concentrated. Taiwan Semiconductor is 45% of the index. We don't have any company which is 45% of index. Right? And Samsung and SK Hynix is now 30% of South Korea's Kospi index. And there are exchanges outside of US. I think Switzerland, again, there are concentration is much higher. So just because, hey, Max 7 is now 30% of the market, that's a lazy argument against why the Max 7 should come down. If you look at the cash flows or the operating margins or the operating income of S&P 500, that's probably 30% of the operating income of the S&P 500 comes from these Max 7. So yeah, they should be almost 30% or whatever, 35% of the overall S&P 500. Why not? Because their business justifies it, right? But again, in these cases, maybe this is not a cause of worry, but just wanted to bring up a point that if you are going outside of the US, getting into EEM doesn't actually diversify you outside of AI. So you're still stuck with AI. I'll skip the crypto market this week. Let's get into the earnings. And then we'll spend another maybe 25-30 minutes on earnings. Then we'll get into the breakout rooms. And then we can dig deeper into any individual topic that someone is interested in. Fair enough? Anything else before we jump into earnings? Because this is going to be the last topic for today, going through the earnings, quickly going through some of these earnings. All right. Let's look at these earnings, starting with Mercado Libre. I own all the stocks that I'm going to cover on earnings. Oops, let's go back to this. Okay, this company just continues to perform. I have nothing else to say about it. The revenue up 40% to $7 billion. EPS was missed. It missed the street expectations, but that doesn't mean anything. I'm not worried about it because there were two reasons why they missed the EPS. One was because in previous quarter, and I talked about it earlier, they had given, they reduced the threshold of a free shipping. And that means a lot more customer orders were eligible for free shipping. That will impact your margins. The second thing is their credit portfolio, which is their new line of business, has been growing like crazy. It's been growing like weeds. It's a low margin business, but it's a high volume business. And that's why overall your margins will be impacted. And that is why you see operating margins slightly down, right? And not too much. But otherwise, I mean, this is for those who don't know about the company, this is Amazon plus PayPal plus eBay of Latin America. They started as an e-commerce business, now added a few years ago. They added a fintech arm, which is their payment systems. So their payment system, Mercado Pago, is used not only on their own properties, but the outside of them is growing, business is growing much faster. So this has become like a principal card or principal payment method to pay for your daily expenses, even if you're doing it on Mercado Libre or doing it on some other merchant website. So amazing business. This is now the top holding, individual stock holding in my portfolio, right? Looking at the business metrics, GMV is up 30%. This is their revenue was up like more than 30%. This is like 27th quarter of more than 30% growth in revenue. Right? I just love the management. Long-term focused, just focus on a business, don't do any stupid things. And, I have nothing else to say about it. So listen to the earnings call. And this is a question that was asked of saying, hey, you're investing in the business, you're going to hit your margins. Like, yeah, we are not managing business for short-term margin. It's a long-term value creation. So if we want to invest in building the warehouses, building the logistics network in LATAM so that they can, do a few hours delivery. They're not there yet. We'll do it. Any holders of Mercado Libre here? I probably been talking about this company when it was like $350 stock. And now it is, I think, $2,200. But yeah, the business continues to do well, man. What can I say about it? Shri owns, anyone else owns. This company is not much talked about because this is LATAM company and CNBC doesn't talk about it. except once or twice I have heard in CNBC. All right,
The
let's.
stock has performed very well this year. It seems to be flat, right? The Mercado Libre.
Yeah, probably not. Let's see where it is. Year to date, year to date is like 31%. Not bad.
Okay, last 6 months maybe. Yeah, I guess maybe the talk of the town is something else. Yeah.
No, year to date is like 31%. That's not bad. Again, the idea is the business continues to do well, and when the market will puke on it, like it puked in last November, because they said we're gonna invest $5 billion in $3 billion in Brazil to build 12 warehouses, and market, oh, it's gonna hit the margins. I'm like, are you crazy, market? If you are a logistics company, if you are an e-commerce company, you need those warehouses, right? Amazon went through the same phase. So market, like the stock was available at 1,600. Like I bought it around $1,700. It was a great time to buy during that time. Like, come on. So if you know the business, market will give you these opportunities to buy some other companies at a good prices. Like it's never like, oh, it's too expensive. No, because sometimes the market will sell it off for whatever reason. All right, now the company that we all know about is Apple. Apple is becoming a growth company again, right? The revenue was up like 7 or 8%. I don't know, after many quarters, we are seeing some 8% growth in revenue, because generally you will see 3%, 4%, right? So it was like Apple is not growing. It's all because of, I think, the not only this quarter, but going for the next quarter. Tim Cook is very bullish about the iPhone sales going the next quarter. So financial numbers all look great. They beat on top line, bottom line, um, record fiscal year. So they finished their year in by end of September. So it was like a fiscal year finish for them. $400 billion, $416 billion of sales for Apple, which is a new record for their annual sales. Now, what did not perform as well was again the Greater China. They were still down 3.6%, so they missed the street expectations. But Tim Cook was saying, we're gonna have the next quarter, China will return back to growth. So market liked it. Again, this was a record revenue for iPhone. Looks like the demand for iPhone 17 is even stronger than iPhone 16. Now, the couple of things to notice here is services revenue continues to grow. For the first time in a year, it has now crossed $100 billion. Like 5 years ago, 5 or 6 years ago, Apple didn't even used to give you breakup of what the services revenue is. This is like a new business unit. Which started to become bigger and bigger. Now it's like $100 billion business, right? And then they gave the quarter revenue growth, which was better than expected. So you not only it's basically calls a triple beat in the street lingo, right? You beat on top line, bottom line, and then you also beat the guidance expectations that the street had. So overall, a good quarter, right? Nothing to complain. Now, the bigger question that I think the street always have had, which is like was an overhang, and I think is still an overhang on Apple, is AI play. Whereas all others, these mega companies, mega sevens like Max, and they're like, we're gonna invest $100 billion or whatever, these huge gigantic numbers on capex. Apple like, yeah, we're gonna do $12 billion, right? Which is, and they don't have to go and build those foundational models. Apple is playing a distribution game. They got their devices in so many pockets that they can be a way to distribute whatever new AI model, etc., to become a gateway to access those AI models. Right? So they're playing a big distribution game. So, oops, where's my phone? So yeah, market liked it, that maybe they're returning back to growth after a few quarters of almost no growth. And they have a big deep pockets as well, right? They still have a lot of cash, but they've been very prudent in terms of acquisitions, etc. I've not seen Apple going out and just acquiring for the heck of acquiring. They've been very prudent, good capital allocator. Yeah, so I'll continue to be Apple shareholder. Asif says Apple seems like a hedge against a bubble crash. If there is any, their investment in progress is absolutely exactly. And they don't have to. I mean, they're not like, okay, let me just go ride the wave of AI. They've been very prudent capital allocators. And forgot to mention, they continue to buy back the shares. Right. So even if revenue, so you also have to look for 4%, 5% revenue growth, plus you see how much of the share buyback they have done, right? Decent run. I don't think the Apple is gonna, the stock probably will return like 20, 40% year over year. Not gonna happen. But it's a stock that will provide, I would say, stability to a portfolio, right? It's not a rocket ship. It's not a growth story, at least for my portfolio. I put it under as a core holding. It's not the one that's going to provide huge growth. Let's look at the next one, which is Amazon. Again, Amazon revenue grew 13%. Again, they beat the top line, they beat bottom line, and the important metric that market looks at it when it comes to Amazon is AWS. AWS net sales were up 20%, which is great because they were growing sub 20%. Like while Google Cloud and Azure, they grew at like 30%, 40% rate. Amazon's AWS has been growing at 17%, 18%. So now they supercharged their growth back to like 20s, like barely 20, right? But hey, it's a good growth. It beat the street expectations, and they beat the estimate on all, right? Revenue, EPS, as well as AWS net sales. And also they provided stronger than the expected guidance. So triple beat for Amazon as well. No wonder that the stock was up 11% because this was getting into earnings. It was not as highly valued as some of the other stocks. So it's gonna revaluation, the multiple probably corrected, and the stock was up like 20%. Guidance was higher. AWS is growing at a pace that we haven't seen since 2022. And I think if you look into, I probably tweeted about it, so get into it. Any Jesse, or was it Matt Gomer? I don't know who said it. They doubled their capacity since 2022 and now they say we're going to double our capacity for till 2027, right? So they continue to see a lot of demand for whatever they're building because still to run all these AI workloads, etc., you need these cloud computing resources. And I think I did tweet about it around their AI plays. Hold on, let me just get to that. Where was its AI? Or did I not? Anyway, so they mentioned in terms of, and again, which is what I missed. So earlier, at a few quarters ago, I think 2024, they talked about Amazon Q. Ever since then, I think for the last 3-4 quarters, I didn't see any mention of Amazon Q anymore. Maybe they have renamed them to Bedrock and SageMaker and whatever the new names that they have for their new AI tools. So that's Amazon. Quickly looking at Alphabet, which is Google. Revenue beat. Operating margin was down because they were fined by European Union. And because of that, that's one-time charge impacting the operating margins. EPS beat. CapEx is up like 83%. We are investing to meet customer demand. I mean, this is the same story on AWS, Google, Azure, as well as Meta. Is we're gonna spend tons of money. We see a lot of demand and usage for it, right? It's some part of, I think on Friday and Thursday, maybe street will like become a little concerned about, oh, that's too much of a capex. But we'll see. As long as they can fund it, it's fine. What may be concerning We will get to that once we get to Meta. But overall, backlog is $155 billion. Gemini monthly active users is 650 million and 300 million paid subscriptions. First ever 100 billion quarter for them. Right? Search is not dead, guys. If you think search is dead, you Google search grew 15%. Right? So search continues to grow. So all the narrative around, oh, 10 blue links are dead. I mean, search also, I guess, include their AI overviews. Right? The Google is now not relevant. Remember, we reviewed the Co2 report where they listed top 40 companies in 2030. Google wasn't even there. A relevant top 40 tech companies for 2030. So from a Co2 perspective, and it was, I think, April report, Google will become irrelevant in another 5 years. They had other companies like Uber, etc., but Google wasn't there. Now I think they ate the crow, and in their revised version, they put Google right on the top. So, but amazing execution. The good thing was that because the street was so pessimistic about it, this was the cheapest stock for among all the Mag 7. So if you knew what business they do, if you've been, tracking their business, yeah, and I increased my position. It's been so far has done much better. It is now what became a third biggest position after a SPY, Mercado Libre. Google is number third. Google Cloud grew at 30% rate. And something that street is now start to take notice is the YouTube advertising. It is as big as Netflix. Now we're looking at a trailing 12 months revenue of $40 billion on YouTube. YouTube is the biggest streaming platform. It's not Netflix. If you look at the number of hours watched, I think the YouTube is the biggest streaming platform. And now the numbers perspective also, I think Netflix did $42 billion. YouTube is like right behind, it's $40 billion. So it's a one big Netflix under Google umbrella. There are 6 or 7 properties, each with more than $1 billion users. You can't just write Google off so soon, which is what Street tried to do it, I would say, a year ago. Right. So that's Google. Any questions on Google? I'll rush through the other earnings. Meta. Some interesting stuff on Meta. If you just like looking at the headline numbers, the beat on revenue, huge miss on EPS. Net income was down 83%. Right? Revenue was up 26%, but the net income was down 83%. So what gives? If you're just looking at the headline numbers, you might think something going wrong with them. So, but nothing. It was a non-cash income tax charge of almost 16 billion that they had to take. I'm not an accountant, but if we have some CPA in this meeting, probably can help us explain what does a deferred tax asset revaluation had happened here. It is because with the new tax laws after the big beautiful bill, the corporates will have to pay lower amount of taxes. So whatever the tax deferred asset was there, they had to revalue it. So the valuation, they had to drag it down, for which they had to take a charge. It's a non-cash expense. So if we look at the cash flow, it doesn't impact anything, but it's an accounting charge. So which drags down their overall net income and their EPS. Right? Otherwise, the business is still doing great. No concerns about it. They bought back shares. They also gave dividend. Ignoring this one-time charge, the EPS would have increased to 7.25. Right? But other than that, not much of a concern. I guess one concern would be, which is what the street got concerned about, is 2025 capex. Earlier they had guided from 66 to 72. Now they're saying we're going to do from 70 to 72. So midpoint will be 71. Earlier, the midpoint was 69. So Street is saying, oh, you're going to spend more money. And on top of it, Zuckerberg comes and says, 2026, we're going to spend even more money.
And unlike, I heard this on TV, unlike Google's management in this report, while Google clarified how they are getting a return on their AI capex, this guy didn't. Zook didn't. He doesn't address it.
Oh,
So
he
the
did.
shareholders seem to think that they are just in the like merrily burning money.
Yeah. So and he is known for it, right? He burnt a lot of money in on Metaverse, and he continues to burn. Look at a Reality Lab. Every quarter, we're losing around $4 billion on Reality Labs. If we go into the I don't know if I didn't have that business numbers that yet. Okay. So Reality Labs, they lose $4 billion, right? But what he did say, and I've not gone through the earnings transcript yet, but I think he said again, I heard on some of this financial media saying, hey, if we are not able to use it, let's say for ourselves, then not for our AI workloads, we can always repurpose these computing workloads for a general workload, not for the AI, but for other, the generally scaling your business. Or we can actually rent this out for other companies, which was like, oh, that's a completely different business, right? So I think that's what the street is a little bit concerned. Oh, come on, you're gonna grow your expense even at a higher rate in 2026, right? Number two, which has got a little more concern for me, was now they actually, these businesses, not just Meta's concern. I think across this, if you want to know what's my little bearish thesis would be, these companies, they were valued so high because they were capital light businesses, right? You didn't have to invest much. All you needed was basically you have a personal cost, R&D cost, but the no fixed cost. But now because of AI, the business realities have started to change. The so-called capital light businesses of these mega seven, means all these tech companies, Google's, they are now becoming capital heavy. If to run your Facebook.com or Insta, if you have to invest so much on the data centers, then you're becoming basically your balance sheet is ballooning, right? And on top of it, Meta comes and say we're gonna do $25 billion of a bond offering, which is oversubscribed by 5 times. And they already did another, basically took a debt from a Blue Owl Capital, which is a private credit supplier, almost $30 billion. They did some JV in which Meta is gonna bring in $3 or $5 billion as Blue Owl is bringing in. It means not only that your balance sheet is bigger, you're also now increasing the debt, right? Meta has generate enough cash to service the debt. I don't think it's going to go down right now. But the way to think about these businesses is they were not as capital light. So why should they continue get the same amount of a multiple that they used to get earlier? So if the argument if we make is, hey, come on, the multiples have not expanded, so why you worried about it? Yeah, but the business has changed. Business has become a little more, capital heavy. So then I should reduce the multiple that I'm willing to pay for it. I don't think we are there yet I'm so worried that I want to get out of it. But these are the signs that I'm watching for in terms of use taking on debt to fund this. At what point of a time the debt start to become much bigger on your balance sheet, or now you're also giving dividend, you have to also service the dividend. These are the things you should watch out for. If you ask me anything, I think Oracle did again a debt offering. Now I see Meta did kind of a 2 debt offerings. That would be thing that I'll be a little concerned about, that now they're leveraging their balance sheet. right? But I think the Meta shares got sold off around 12%. I think because of two reasons. One is capex. The other thing probably is around their debt offering. Otherwise, this business side, they were still doing all great. I mean, average revenue per user is up. The overall number of users that they have still continue to grow. It's already more than 3.5 billion users. You take China out because Meta is not, China doesn't allow them to operate in China. So you take that population out, right? There may be 75 or 80% of an internet accessible population already on their platform. Right? So it's huge.
So Vivek, with all this capital expenditure, how come the gross margin is still increasing? It should be decreasing, right?
So some of them have come, gross, right? Some of them have actually come forward, and like I think it's Microsoft that they had a reduction in some of their operating margins. There have been some pressure on margins.
Yeah.
And someone has.
Because very healthy.
It is still healthy. I mean, they're starting from huge. The initial starting number itself is high, right? So Meta's operating margin is down 2.7%. So, and the CEOs, I've been saying that, hey, because of, I think it's Microsoft, was it Google? They say because of three. One is investments in personnel. I think maybe it was Meta. Because they hired a lot of these AI engineers and all that stuff. Then investment in infrastructure. And there was, I think, one more stuff that they mentioned. Because of these three, there is why our margins are pressured. When you say pressured, means still very healthy margin as compared to others. But then you can't give them the same multiple which they used to enjoy earlier. That's the stuff I just want to watch out for. How much of a debt?
Because they've taken on, right? Yeah, because they've taken on debt, right? They'll have to
Yeah,
repay the
now
debt.
they're getting under the debt.
Yeah, and that will go against the margins for a long time, right? And the other concern I have is I'm not sure, I'm not an expert in this, right? But I think the data centers don't have too much of a life because the chips keep on getting upgraded. These AI data centers, I don't know what their life span is.
So we'll have to see. And these are the games which I've seen Google playing it, Meta playing it, that they will change the useful life, and so that they'd have to take a lower depreciation and hence bump up the price, bump up the net income. But now with the GPUs, the question is, so earlier I think they have a useful life. Google moved it from 5 years to 6 years for their servers. Now the question is, if you're getting NVIDIA's GPUs, is 6 years still relevant useful life? Are you
Yeah,
going
that's what I'm saying. It's shortened actually rather than length.
right? No, but see, as a CFO, I can play a game saying that, hey, for my AI workloads, the GPU is not enough, but I can still continue to use GPUs for my other workloads.
Yeah, true.
So that's a game that, we will see them playing. But let's say if your business is only providing AI cloud capacity, companies like CoreWeave, companies like Iron or whatever, I pick these newbies, Nebius, etc., where you don't have any other business, like Google has other businesses as well. How do you justify using 6 years as your depreciation schedule for GPUs? I will get worried if CoreWeave says that we're gonna depreciate over 6 years. Come on, man! NVIDIA's chips, like after 3 years, you can't use it for new AI workloads. So that will be financial engineering that you should watch out for.
Right.
Okay. All right. Final one is Microsoft. I just put it today morning. So Microsoft again beat on top line, beat on EPS, marginal slightly down. CapEx, they had a $34.9 billion of CapEx. Cash outflow was 19.4, but because they had a financial lease. So if you're looking at a cash flow statement to see what's the CapEx, you may not get the right picture because the rest one was through the on the financial leases. Overall, great quarter. Slight miss on the margin due to high investment in infrastructure. That's what the CFO said. again, the more important stuff that folks look at, market looks at, is Azure growth. It's up 40% year over year. So same quarter last year, it was up 33%. So even at a higher base, it's growing at a much faster pace. So Azure growth grew 40%. Overall cloud revenue was almost $50 billion. So annualize it to close to $200 billion, right? RPO, remaining performance obligations, increased by 50%, right? So this is like a deal signed, but we haven't yet delivered the services, which are average duration of 2 years. So even if they don't sell anything new, let's say all sales folks go on holiday, they can still meet whatever their current annual run rate is. Oh, no, let me put it that way. This is commercial RP. I don't know if it is only cloud or it can constitute everything. So I'll take that statement back. Because only the cloud was $50 billion. So probably this may be including all other commercial, let's say software, etc. also, which I don't have that number. But even if you don't sell anything, you could still have a $200 billion of a existing commitment that you will basically eat upon over the next 2 years. The return $10 billion to shareholder through dividend and share repurchase, overall pretty decent one. More important thing is the OpenAI relationship that has been a little testy for a few quarters. Now they got some clarity because OpenAI finished their restructuring this week. So we'll look at OpenAI restructuring. What OpenAI now had done is basically there's a non-profit portion of OpenAI, which they call as OpenAI Foundation, which will select the board of directors for the for-profit group, which is called OpenAI Group. And this foundation has 26% of stake in OpenAI Group. Now, the reason why they had to do this was to meet this whole AI stuff or the AI workload. You'll need $1 trillion of plus investments, right? OpenAI has already committed $1.4 trillion. They told Oracle, oh, we'll spend $300 billion with you. NVIDIA will spend so $100 billion with you and all that stuff. And OpenAI has what, $20 billion of a revenue? If you listen to the recent interview of some Altman, he says, maybe you have grown much bigger, maybe $50 billion. The whole idea is how they're going to meet this $1.4 trillion of commitments. You need to raise external money. If you want to raise external money, either for going through the private route, they will need to see their investment grow. So they wanted to have a separate for-profit entity, and now they've finalized the structure, but based on their initial agreement with Microsoft had to sign off on any restructuring, which now they have. So now we have a clarity on how it's going to operate. So for-profit entity now will be able to tap resources, financial, because they need $1 trillion. They can always tap now public market. And there is a news that maybe they're looking to go public. We don't know when it will be. But now they have a various ways they can go to the private market, public market, basically tap it. And also, OpenAI Foundation got 26% stake. If you look at the latest funding round, OpenAI is valued at $500 billion, right? So another $125 billion. It's probably one of the top richest foundation, if not the top one foundation in the world. You got $125 billion to do some charity work. Microsoft, we own $27 billion, sorry, 27%. And the OpenAI employees will have 26%. Then other investors like SoftBank and whoever had invested earlier, they have the stake in this new entity. So that's how the new structuring is. Now, coming to Microsoft, why I bring this up? Because how it impacts Microsoft. So they have a Azure compute commitment from OpenAI of $250 billion. We already talked about it. They will continue to enjoy exclusivity to distribute OpenAI APIs till 2032. So they've extended it for a few more years. Now for 7 more years, they will have this exclusivity. They also will have access to OpenAI research, all the research that OpenAI team does. They have access to it till through 2030 or until AGI is achieved. And I think this structure also has some guidelines on around they will form a panel of experts who will then opine on whether the AGI has been achieved or not. So assuming that we are still far away from AGI, Microsoft will still have access to the latest and greatest research from OpenAI till 2030, right? Then they also have a rev share with OpenAI. 15% of the OpenAI revenue is going to Microsoft, and they own 27% of the equity. Let's say OpenAI, say the revenue is $20 billion or $30 billion. They come public, right? And they come public at whatever 10 or 50 times sales. So I mean it's a huge stake for Microsoft, right? So I think there's still a lot of tailwinds on Microsoft.
Yeah, that's a good deal for Microsoft.
That's why they agreed to sign it. So OpenAI would not have been able to restructure it without the blessing of Microsoft. Right. So from a Microsoft perspective, I think they still got a good deal. So
the only thing Microsoft, amongst the big tech, right, they don't have their own LLM model, right? They're still relying on OpenAI.
Correct.
That's the only, but then I guess if they have access to research, because I think they hired this new guy, right? Mustafa or something, Microsoft did.
Yeah, to lead their AI.
Yeah.
Mustafa Suleiman.
He's a big guy.
Yeah. So anyway, I mean, it's a good deal for Microsoft. So I'll continue to be a happy shareholder of Microsoft. I see these big elephants can continue to dance. We don't always have to find the smaller companies because you never know when those companies might die. I would rather put more faith on Microsoft than, let's say, on Oklo. Despite whatever the share prices might have done, that's a different matter. But that let's look at how Oklo has done. See, the stock is up 500%. Good for them, those who are on Oklo. I will wait for them to actually build a real business. All right, what else? We are already 12:30, so I'll stop right here and maybe we open the breakout rooms. And if someone else want to talk about Chipotle, we had Netflix announcing the stock split. We can talk about some other companies also. Storage companies, they all are like close to 200% gains, right? Yeah, one final thing, just from transparency perspective, the stock buys and sells. I bought the Meta, I bought the dip, but stock dipped even after that. Who cares? I didn't buy it for 1 week or something. And then I parked something into SEHD because it was down. I'm like, yeah, this is again one of, if the market will zig, SEHD will zag. So I want to have something which is balancing it. I sold a little bit of a Google, little bit of Amazon to sponsor the purchase of Meta so that overall on this big tech, I don't overexpose myself. I just moved a little bit of a capital from here to there. Right. Still bullish on Google, still bullish on Amazon, but I wanted to buy Meta. And I didn't want to add any additional capital on AI plays. So I had to find money from somewhere. So that's what I did. All right. With that, let's open the breakout rooms. Thanks. Anything else? Anyone else have a question before we get into breakout rooms? Okay, sorry.
Oh, sorry. I just saw something on Reddit, but I think the line above this, can you just scroll it down a little bit?
Reddit was up 12%.
Okay.
Yeah, Reddit has been doing great. This is a company which I knew it was riding on the wave of the data to train models. But again, the whole thought process, I didn't invest in Reddit because I'm like, I already have so many AI plays. Right now, still the AI play. But they've performed really well. business-wise also, not just the stock, but the business has also done well. I see a question, sir. You say, what are the reasons MSFT is growing? What's its value, or is it? For me, it's a long term. I mean, look at a Microsoft knows how to sell to enterprises, right? So Google can't compete in that area. Google is more consumer facing. Microsoft is more on the enterprise side. They have a very deep hold on enterprise. Azure has recharged their growth after Satya Nadella came in, and now with an AI and all that stuff. Those are the tailwinds. Now they got such a sweet deal with OpenAI also. Cool. All right, let's open the breakout rooms. So the rooms are open. You can go and join whichever one you feel like joining in. If you have any other questions or want to talk about anything other related to investing, I'll stay in the lobby for some time. Then I'll go and join in the breakout room. What else, especially to anyone new still here? What are you looking at? What kind of investor are you?
Vivek, what happened to your Tesla and IWM switch?
I mean, it's
Top 15.
so yeah, so just from a price perspective, I think Tesla, I had sold a little bit of a Tesla because my call spread was in the money. So that probably reduced a little bit of a share count. Let me go back and see, because I put a note when I have done a put spread on Tesla. Hold on.
I see that you purchased IWM or you got.
No, I didn't buy any IWM. No.
So it just moved up?
IWM probably just IWM moved up, or probably Tesla. Let's just look at when was the last Tesla trade. Yeah, so Tesla, I closed the covered call and sold some shares at 433.
Okay.
Okay, now I think I have a put spread on Tesla. Let me look at what's my open trades on Tesla.
Put that information in here, the sells and buys.
Yeah, but Tesla, I didn't sell it in this week, right? So I would have told in a previous week. So now on Tesla, I have a short put spread at 410, 380. So I sold at 433. If it goes below 410, I will refill the tank. And then I have a call spread at 540, 570. 540, it will be like too overvalued. So I will be okay to sell some more shares. Anything around 420, 430, 440 Tesla, unless I see a new business, new quarterly report, I'm okay to sell a little bit of it.
Okay, sounds good.
Yeah.
One other question. Do you wait for a particular amount of returns before you get out of these stocks? Let's say 50%, 20%, 100%?
No, I don't have such. No, I don't have such rule. If I only get out of it if the business has stopped performing, or if the stock has run up too much as compared to business. But whether it's given me 50% or whether it's given me 25%, that is immaterial.
Okay.
So I will not sell the stock if the stock is up like 3x. If the business continues to perform and is still at not at an egregious valuation, I will still hold it.
Sounds good.
Why would I punish the company to do what I wanted them to do anyway? I wanted them to build a great business. They build it, then I'll not sell my stock. So no, I don't have any price target in my mind. Alfred says, can you go to Chipotle earnings? I didn't have earning, but I think the issue on the Chipotle was that the same store growth was almost stagnant. I don't own the stock, so I didn't do my like earnings like I do like this. But let's look at Chipotle, CMG. Ever since Brian Nickel left, they've been having little tough time. Oh, so now revenue grew was 7%, but majority of the growth came from them opening more storefront. So when you're investing in any restaurant chain, what you should focus on the same store growth revenue, not just the overall revenue. Because I can go and open, I can just increase the store count to increase the revenue. So I'm looking at Chipotle's revenue grew 7.5%, but have they mentioned their same store growth? Yeah, comparable restaurant sales increment is only 0.3%. 0.3%. So it means all the revenue growth is coming from you just opening new restaurants, which means it's a little dicey situation. Means you're not able to grow the sales from your existing restaurants, right? So I think that's why the stock sold off, because I'm looking at total number of transaction decreased, and they have been decreasing for like last 3 quarters. Average restaurant sale is 3.13 million, which is in Q1 2024, Q2 2024, it was 3.15 million. Now they're even less than that. So clearly the average sales and the same store sales is going down. It means they have to figure something else out. There was actually a tweet by not such a famous person, and Bill Ackman tweeted it because Bill Ackman owns a lot of Chipotle shares. So someone had tweeted saying, this big damn burrito that you have, maybe cut it into half and sell it for $10 because it's so expensive. I mean, I pay a lot of money to Chipotle. I mean, probably today also I might just go to Chipotle and have lunch. But they said the burrito size is too big, and that probably have kept a lot of lower end consumers who might be feeling the pinch of, might be a little constrained in their spending to not come to Chipotle. So maybe you should reduce the size of burrito and sell it a little cheaper. And Bill Ackman actually tweeted it and tagging Chipotle management saying, not a bad idea. Maybe we should try it. Some rando guy, and Bill Ackman is retweeting that one. So Alfred says CEO of Chipotle said that they will build every 24 hours a new Chipotle location this year. I don't know how great the strategy is. If your individual locations are not able to grow and are actually reducing the margin on individual location, that's a bad revenue growth. You are actually, by increasing the revenue, you are basically reducing the shareholder value. This is like destroying the shareholder value. So not all revenue growth is same. Some revenue growth are value accretive, some revenue growth are value destructive. The fact that they are basically losing margins on their individual stores, they should stop increasing the store, fix that problem before they try to increase their store count. Again, I don't know. I have no stocks in restaurant businesses. I don't understand the industry, but common sense says, guys, maybe CEOs compensation system is tied to revenue growth. Who knows? I don't know. So they should focus on increasing their same store sales than more and more stores. Whereas I think the Brian Nickel went to Starbucks, and let's look at what Starbucks has done. So I'm looking, wow, Chipotle. Now the stock is where it was in April 2023. The stock has gave up almost 1.5 years worth of almost 2.5 years of gains. which is not a good situation if you are a Chipotle shareholders. I mean, restaurant is a difficult business to make money in. That's why I just don't own any restaurant business.
Well, at the like in the last 3 months, there's also a temporal factor. Like all these food stocks, like Kava, Eat, everything is like dumped. I think the consumer who goes into these is really hit hard financially.
Is it? So let's look at Kava. I remember a lot of you guys were. I mean, when I say you means
I am in Kava, and
the
it's
folks in
unfortunate.
our Saturday meeting were super excited on Kava. When I reviewed the Kava after their when they came IPO, I reviewed its S1, and again I don't understand this industry, so I did invest on it. But now the Kava is available not too far away from their IPO. So if you
Right.
thought you missed the train has come back to station.
I think I missed the importance of the owner of this company selling huge time, big time, just before it took a dump. So that's a very big signal I've seen over 30 years. Like insiders who are majority, like let's assume a stock is owned 30% or more by a company, by one guy. And if he starts selling, then babe, you get out.
Yeah, that could be one signal, but I know buying is a sure shot signal, but I mean, you will buy it only if you think the stock is going to go high, but you might have to sell for a lot of other reasons because 99% of your net worth is tied in these stocks. Just as a shepherd of a capital for my family, I need to take a decision to diversify. That doesn't mean that the company may be bad. Again, it depends on if he sold something, how much he still has, how much skin in the game he still has after he has sold that. So it will be case to case basis. So I do not consider selling by CEO as a bearish signal if you still have a skin in the game. It might be they just want to do the right thing for their family. But you would buy it only if you think that the stock is going to. So that I will pay a little more emphasis than on the selling side. But I'm looking at, so this is what I hear, right? Restaurant is always a low operating margin, high volume business. So you need to scale up. And maybe the Kava will do good. But yeah, I didn't own it. But now it is like I said, hey, it is even available at a cheaper price than immediately after IPO.
So you're saying it'll do well because of what reason?
No, I'm not saying anything around Kava. I don't understand. I mean, I'm not looked at their business. This is what they want to be Chipotle or for Mediterranean food.
Right.
That's their pitch. That's their pitch. The question is how Americans, can we change the food habits so that they want to go and have a lot more Mediterranean? I don't know. This is an industry which fashion and the food and this industry, I have no idea, makeup and all that stuff. I don't know. It may be difficult to change people's food habits.
Well, we don't have any in the West Coast, any kava, but like I guess they're trying to expand just like you're observing Chipotle did. And so the thinking is, oh, well, America people do eat all this falafel and all these other Greek type stuff, so they might get
Yeah, the question of what's percentage? I mean, Beyond Meat wanted to change the food habits.
That's different. I mean, people eat Mexican everywhere and people eat Mediterranean everywhere in USA.
Yeah, that will be great. Again, I don't own this because I don't understand this space, so I will stay away.
Vivek, I have a few questions. One, and this one's options related. When you are in the options play, do you practice exiting all options positions before earnings as a rule of thumb, or is that more generic?
I will try to. So let's say if the stock is, and again, there are a few things that get into that decision. For example, this week, I closed some of my positions which are going to report earnings, let's say 5-10 days, 10 days later or next week, because I know the IV might go higher. So that will go against me. But there are, let me tell you, a few things that will be a decision-making points. Okay. Number one, that the IV will expand, right? But if there has been any event prior to it in which the IV has already risen, then, I might discount that. Number two, if the position currently is not neutral, let's say I had sold a iron condor, and right now the stock is sitting at a on the put strike. It's not centered, it's on the put strike because the stock has fallen down. Now, for me to profit on it, the stock needs to be, this trade has become a bullish trade. It means the stock has to go high. Do I want to have a bullish trade in my portfolio? If yes, then I'll keep it. But if, let's say, I'm looking at the market or looking at my stock, it's already hit all-time high because whatever reason, now I think, geez, now for me to profit in this, it needs to go higher. Then I might close it before, because I don't want to have that bullish exposure. Let's say for Microsoft, I had an iron condor and I did not close it because it was centered right in between. No, it was not even in between. It was near the, like, to the right side of the call of the center, means if the stock falls, my option rate would have benefited. So that was like a little bearish one. I'm like, I want to hold it, because if the stock falls, my long positions will go down, but the option trade will benefit. Right? Stock didn't move much anyway, so just the IV had it decreased, or maybe it was centered somewhere around that. It was not a bullish trade, so I held it. But I closed, let's say Alibaba, I closed C Limited, because C Limited again gonna report earnings actually. Just because those iron condors stock had fallen down, so they had a bullish delta. I already own a stock. It means I already have a bullish delta on it. So I didn't want to depend on an earnings move for that. So I closed at a lower than my general profit target would be. So these are all things that I will look at it before I decide what I want to do. There's no one cut reason.
Right. And do you just literally look out for the light bulb sort of signal on Thinkorswim? What's your system to remind you, okay, earnings coming up on this?
I know that the earnings are coming up because I track those earnings, and
Right.
on my sheet I have, okay, which are the stocks that are expiration, what are the ones that are expiring in this week or the next week, and I based on that those are the stocks that I look at immediately, saying, do I need to do anything on the stock? Now, if there were no earnings, then my idea would be generally I should start to close down my positions around 3 weeks before the expiration. So November 1, I would be actively closing it. And in fact, I've closed some position wherein it hasn't hit my profit target, but I'm like, it's getting closer to expiration. Might as well close it. It's okay to make less money. And maybe then I'll put on a December trade, give myself a little more room and little more time. But earnings is generally tricky because stock can move a lot during earnings, right? And then if I already own the stock, I don't want to have any more bullish exposure, then I will like, you know what, let me close this and not subject to that earnings movement.
Right. Yeah. Because I'm contemplating something similar. So the Berkshire earnings just came through and they seem to have sold a whole load of stock.
What did they sell? Berkshire's?
Well, I think they've sold,
Let me
can go into the detail. They've sold what, 6 billion plus worth of positions, and now which has led them to have more than 360 plus billion on their books.
Berkshire cash hits $584 billion.
584, sorry. Yeah.
Wow.
There you go. Right.
I'm just
So
looking at They reported its profit rose, cash by balloon to 500, sorry, or more than, why the headline shows something else, the details show something else. Did not announce any stock buyback. Operating earnings are 13.5 billion, up from 10 billion a year ago. Wow, that's like 30 billion jump in operating. They were largely attributed to surge in insurance income. Cash and cash equivalent 387 billion.
Are you looking at stock analysis? Sorry, I can't see your
No,
screen.
I'm just sorry. I just
Just reading the news article.
because here it says 584, but on the other website it says 381. So here it says $381 billion.
Yeah, Financial Times I saw somewhere plus 360, so it's upwards of that. It's a big number.
Oh, so this 584 maybe in a which dollar is it? I don't know, AFR, maybe a different, it's maybe I don't know if it's in a different dollar. But anyway, so cash record $381 billion. Okay. Berkshire is the one company where I don't even look at, I don't even analyze the earnings because come on, these guys generally do a good job. I don't have to watch what's happening with Berkshire. Profits rise 17%. Gains were driven more than 200% surge in underwriting income. Refrained from repurchasing stock. So right now the stock won't even move. So we'll see.
You reckon it's not?
Yeah, it's a holiday.
Not gonna go through the roof on Monday.
We'll see. So
We'll see.
damn it, I had a put spread and then I added a little call spread. So I have an iron condor on Berkshire Hathaway. Generally doesn't move much. So BRKB. Yeah, at 485, 445 put spread, which was in the money. So I thought maybe I'll buy slash 485 for, then I did 520, 540. So beyond the expected move. That's for November. So this is something that I should be, if it goes up, I should be able to close it for decent profit because it will be, if it goes to minus 485. Yeah, we'll see. I mean, it's a good company, so I will buy some shares if the put spread expire in the money.
Yeah. So even with a report like that, it's hard to tell what the stock will actually do
Oh
next.
yeah.
Yeah.
Stock price movement, nobody can tell what's going to happen.
Yeah. And I think
who wrote the shareholder letter?
I think Warren
Was it
Buffett
Greg Abel
signed
or
the quarterly
Warren wrote
report. So Warren Buffett still signed the 10Q, I think.
it? 2025. Like a $1 trillion company, and this is their website. They don't care. They are not selling their stocks for sure. They are not marketing their company. This is the Berkshire Hathaway website. Let's go to see. That's their main website. Okay, let me just download this. Yeah, more interested on the operating income because their net income get all constituted by all the investments that they have done. So let's go to statement of earnings.
We've got some insurance losses due to the LA fires.
No, not equity method. Earnings before income tax and equity method earnings. Yeah. 30, which is third quarter, $37 billion. Not bad. Yeah, like I said, this is a company I don't have to focus much on. I never even had a 2025 2025. Don't even have a folder for it. What else? So Berkshire did today. Let's see what Uber.
And then finally, there was a thing on balancing the long-term investing mindset, which kind of says, okay, you acquire the share whenever it goes down versus the short-term option trading mindset, which says, oh, keep buying power to less than 30% and cut the option position close to earnings or before more than 21 days to expiry. Any thoughts how to balance those two different mindsets?
Yeah, I mean, this is like always a struggle because someone hears me, I am involved in option, they think I'm a short term. And no, I'm a long term because I want to own the stocks forever. But it's like, I mean, the way I look at it is I'm on a long journey, but then I have to climb individual steps, right? So my options are like individual steps. And I want to make sure that I don't do an option trade, which will, let's say, for example, if a company that I want to own, let's say Berkshire Hathaway, right? I sold a call spread. I did not sell a uncovered call because I don't want my whole stocks to get called away. Let's say if the stocks explode to the outside, right? So that's how at least I found over the years is in terms of change your option trade so that you will still continue to hold some core position in your portfolio. So every position that I own in my portfolio, I have a number against a column called coffee can. I don't know if you started joining this one or not, maybe in 2024, January or February, somewhere. I I read, I think in Chris Meyer's book, something called coffee can portfolio. And I really like that concept. I said I need to implement it in my portfolio so that I know that anytime I'm doing this option trade, I will always have some minimum quantity that I will hold in my portfolio. And let's say, for example, let's say Google, right? I might have mentioned in a Google that I will keep 150 shares or 100 shares in a coffee can. So when I'm trying to do an option, when I look at a Google and let's say if I have 250 shares or 200 shares, it will tell me I can do only one. I can sell only one covered call.
Right.
Unless, so prior, like earlier, I did not have the concept of a coffee can portfolio. And once I understood it, then I said, you know what, limits figure out of all the stocks that I own, how much of that I want to put in a coffee can and forget about it for next 10, 15, 20 years. Right?
Yeah,
There are some stocks which are like, yeah, I bought it. If it gets called away, it's fine. In which I will not put anything in coffee can, but some of these like Googles and the Microsoft of the world, I'll take some of it, put it in a coffee can, and then do an option on the remaining stuff. So that's how that has helped me in make sure that I just don't get out of those stocks that I really want to hold it for everyone.
Yeah. No, thank you. I think I need to, develop a similar system. Yeah.
Yeah. So then if I like say tally up in terms of my overall coffee can, I'll say, okay, 60% of the value of a portfolio is in coffee can. Yeah, I'll play for 40%, I'll play with it. Right. Or if you want to tweak your coffee can, it's entirely up to you. I will look at it. each stock and determine each company and then determine, okay, how much I want to keep in coffee can. Like Xpeng Motors, right? The Chinese one. I had a few hundred shares, and then I said I want to put, let's say, 300 in coffee can. Right. And then I did a covered call on the remaining ones. The stock ran up and those got called away. But thank God I kept 300 in a coffee can because the stock was up like more than 100%. I'm still able to enjoy the ride. That's it. I learned my lesson. I don't want to get, I want to make sure I have some coffee can allocated. So that has helped me.
Yeah. No, thank you. Thank you for sharing that. Slowly and steadily develop a system.
But yeah, I think the mindset is important. It's just that sometimes you read something. It's not that it is rocket science or anything, but just then it just strikes. I'm like, wow, this coffee can is amazing. We always knew. I always wanted to hold the shares, but I never kind of formally have added it as a practice in managing the portfolio, which is then
Yeah.
I did.
Yeah. These are two opposing mindsets in effect.
Yes.
And so something that gives you like a system that helps you helps me maintain sanity, or what exactly am I doing? You know? So yeah. Thank you.
Cool. All right, I see. Look, options and futures is crowded for a change. Last week options wasn't crowded, but this today is everyone is in options and futures.
Hmm.
Or does anything else? Or will there is one book on coffee can industry. Coffee can industry, the low risk road to stupendous wealth. Wow, thanks, Rohit. I actually heard about coffee can in I think Chris Meyer's 100 Bagger book. I read that book. I think that's where I saw the concept of this coffee can. Um,
Yeah, it's a good one, but it's mostly, I mean, it's from an Indian founder into the fintech world. But yeah, it's more on an Indian context, but the concept is
the
good.
concept is same. By the way, I did not read like those two books which I shared last week. I have not read even a single page. I think even because I've been all busy in this earning stuff. So book reading is on pause.
Yeah, limited time and multiple things to do so.
Yeah, hold on. Look, someone at the door. I'll come back.
Hey, why don't you guys join the option group? There are about 10 people over there.
Yeah, I'll do that. I'll just join. Thank you.